Bobby kind of barging through the door, and he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. You know, over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves. And they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, you know, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself. But at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it.
WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3 in amongst that, was very successful and made very large amounts of money as a young man. But inevitably mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, oh, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects. And the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, Hart in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now, we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was has Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest, because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in a few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, we'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source. and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's world headquarters in New York, and this is Bloomberg Green.
Low volume, low energy here. One of the final trading days of 2022, a wild year, and well, it looks like it's going to end in a similar fashion. So I guess what it's been all week. Romain Bostic here alongside Carol Massar and Tim Stenovic. All three of us, for some reason, in the squared circle here on this day after the day after Christmas.
One of the very few, it feels like, in Bloomberg. It does feel kind of quiet, but nonetheless, the markets are up and running, and we've got some news, certainly when it comes to overseas news. We'll get to that in a moment, Romain.
Yeah, a lot going on here, and I think the price action that we're seeing today is really so indicative, I think, of the seesaw that we've had for a good portion of the year here. The idea that energy is out front once again. Meanwhile, at the back of the bus, it's basically what has been for pretty much the most of the year. That we're talking about consumer discretionary stocks as well as tech stocks, as well as a lot of people reevaluate valuations heading into 2023. A lot to talk about here on the show on this Tuesday afternoon. And I guess we got to start off, guys, of course, with the reopening, I guess the fuller reopening of China right now. And, well, the reaction to it isn't quite all that positive.
It's interesting to see this, Carol, because, you know, for years we've talked about the idea of COVID zero, right? This essentially ends 3 years of lockdown. I think it has really serious implications in the long term. It could be very good for China's economy, for the global economy, but in the short term, a lot of pain ahead because the country just doesn't have herd immunity.
Well, here's the other thing. It's a good story. It's a bad story. In other words, yeah, great to have the second largest economy in the world reopening. What does that mean for global growth? That's one question. The second is, what's the drawdown or drag when it comes to demand, that increased demand potentially coming out of China as it reopens out of that COVID zero? Romain, I've got to think about what does that mean for global inflation? We're already seeing it play out when it comes to some of the commodity trade today.
It was already, of course, a big story in 2022, going to be a big story in 2023. I think the big story, at least for this week, is if you traveled somewhere, you're probably still trying to travel somewhere. A huge winter storm that swept a good portion of this country, and now a lot of flight cancellations, and even the president weighing in on this.
Yeah, shout out to my family right now who's in the car making their way from Western New York to Detroit to try to catch a flight to make it back to the West Coast because that Buffalo airport continues to be closed until at least tomorrow.
So they decided to go from the snowiest place on the East Coast to the snowiest place in the Midwest in order to catch it. You know they can go south, Tim,
you
right?
You got to talk to your family
Florida
about that
was
strategy.
Very cold this time of year. The only place that didn't get a cold snap pretty much was California, where we're all from. So next year, maybe we'll do Christmas in
Absolutely,
California.
and there's no problems going on in California right now. Hey, how did you guys make out this holiday season?
Shopping-wise?
Shopping-wise,
Spent a fair amount of money, but I
Yeah.
saw a lot of like 20%, 30%, 40% off even before Christmas. Saw that on Christmas Eve big time.
Have you looked since?
It's even better.
My email is like full of all kind of discount offers, so I'm trying to resist the
I
temptation.
kept my stocking upside down. There was nothing in there from you, Romain, and Carol. Not yet, at least.
Well, you know. We like sales. We like to shop for sales. All right, that's kind of your big picture, certainly on this Tuesday after Christmas. Let's get to some of the stocks on the move. I'm going to give you some of the gainers, and a lot of it plays into that COVID China reopening story. And so, as I often like to do, you guys, don't throw tomatoes at me. Golden Dragon China Index. That was one of your standouts.
I did not see that one coming.
You did not? You got to wake up a little bit more. Have some more coffee. All right, so that index is up. You can see 1.8% for our folks who are watching also on radio and listening on radio. That's up about 1.8%. If you look at the NASDAQ specifically, your top gainers include many of those Chinese ADRs that trade here in the United States. So China rolling back on the last of its COVID curbs. This is going to was a big story here in 2022. We know China will continue to be a big story in the new year. That index, by the way, it's up about 53% since late October. Now, related to this, made us look at all the gaming companies with a lot of exposure to China, Macau specifically. That includes Wynn Resorts and Las Vegas Sands. Wynn Resorts, you can see up almost 5% just shy. Las Vegas Sands also one of the outperformers in today's session. And then I wanted to take a look.
I wanted to. I think every person who has a Bloomberg terminal should pull up a chart of Las Vegas Sands, of Winco, of Melco, of Wynn, all of these sort of companies that have that exposure to Macau, have that exposure to China. It's been a roller coaster ride because we go through this every few months. You start to get a reopening, you start to get to see this movement amongst Chinese nationals over into those areas, and then, of course, something happens, COVID outbreak, lockdowns, etc. Is this going to be a repeat?
Las Vegas Sands is up almost 40% since late October.
It does seem like this reopening is different because the country has essentially scrapped the way that it's talking about COVID and the way that it's been talking about COVID for 3 years. And look at the travel restrictions that have come down. So perhaps investors are onto something, at least this time around.
Yeah, and they're calling it something different. All right, we're also looking at commodities. Romain mentioned that at the top. Just pulling up Barrick Gold, you can see that's up about 2.5%. We're seeing certainly some interesting things happen in terms of a lot more of a risk-on trade to some extent 5% today because of that COVID news, so maybe backing off of, we've seen the dollar retreat, pressure on the dollars, risk assets are gaining a bit today, but gold, because of the commodity play, some of that is up today. We'll talk a little bit more about iron ore later on. And then bookings, that popped up top of the NASDAQ 100. It's up more than 20% since about mid-October, still down about 16%, but we're going to talk a lot about travel today. It's been tough for a lot of folks over the holiday season, but nonetheless, I was in an airport on Wednesday, and it was crowded. That's all I'm going to say.
A lot of people perhaps still in an airport after a couple days of trying to get home. We're also going to talk a lot about Tesla today. Shares falling today again for a 7th day in a row. Shares down 8% as we speak, another $10 on the decline. This over demand concerns. We had that report out of a plan from China to temporarily halt production in its China factory close to Shanghai. This is right now on its longest losing pace since 2018. We're going to dig into Tesla a little more a bit later in our program. And the travel woes continue for Southwest Airlines.
Is there not, I mean, I'm sorry, is there nothing that Elon can, I mean, can he not tweet something that will turn this around?
You know, I was, were you on vacation
I'm selling Twitter?
Romaine, you were on vacation last week too, right?
I was. Okay. I mean, technically I'm always working, but yes, I was on vacation.
Well, I am too, unfortunately. I mean, I can't stay away from this stuff. So last week I listened to that Twitter Spaces.
I'm going to teach you guys to meditate in the new year. Just everybody has to take a break.
That's one of my resolutions, okay? Well, Elon Musk getting some flack last week from some big investors, including Ross Gerber at Gerber Kawasaki. He had this Twitter Spaces. He did say he would look for a new CEO of Twitter, so perhaps we'll start to see some changes there as well.
Who wouldn't want that job?
That is a good question. Southwest Airlines, we're talking about travel a little bit later in our program too, down another 5.8% today. Then AMC Entertainment down 8% after last week's decline. We'll get to that a little bit later in the program as well, Romaine.
All right, well, right now, though, we want to talk a little bit more about the trade, what's been going on this year, what's going to happen in 2023. With us, we've got a great voice, James Demmert. He's Chief Investment Officer at Main Street Research, roughly $2 billion in assets under management, and he joins us via Zoom here in the United States. So, James, good to have you here with all of us. How do you think about, we've just got a few more days left here in 2022, that China news, does that dramatically change your thoughts for 2023?
Happy holidays. No, it doesn't. And I think that this is the hallmark of 2022 is that the markets continue to fool themselves, that the Fed is done, China's going to reopen, inflation's coming down faster than expected. And it's just classic bear market rallies, with this head fake that we've been going through throughout the year. So I don't, and our research suggests that this bear market, we've made a lot of progress. I'd say we're 2/3 of the way through it. But the valuation of equities versus what's going on with Fed policy and the economy, they are in disequilibrium. And that needs to be brought together. And we think it probably happens in the first quarter, right before we start a new business cycle and a new bull market.
Well, what's the catalyst for that, though, James? I mean, when we talk about what gets us to that equilibrium, is it a Fed pause? Is it that pivot that everybody's waiting for, or is it something else?
Thank you. I don't think it is as clear as people would like it to be. And I think you could go back to a metric that we use often when the Fed is in this pickle, which is you really want the Fed funds rate, which is now, 4 and change, to be closer to the inflation rate, which is 7. So we're far away. So that would be one metric I would look at and say, those two have to come together. Now, that can happen with time, and I think maybe a few months might do it. Or it can come with prices, right? Inflation could come down faster than expected. So any of those things could cause the Fed to be less determined. But we know from their last meeting, they made it very clear they are determined to try to get to 2, which we frankly think is a recession without question. I mean, you're far from 2 at this point. So they would really have to bring the hammer down, and they may. And I think that's why equity investors need to understand it isn't over yet with the bear market. Now, the bull market's not far, but price-wise, it could be painful before it gets better.
Well, how painful? Because I know that you and the team expect that the market will bottom perhaps in the first quarter of 2023. How deep is that bottom? How painful is it going to be? And what kind of bull market are we expecting in an era of higher rates?
I think those are great questions, and there's some that you want to make a New Year's resolution about to bring that up.
Granted, that and meditation, I'll do it.
Right, if you own Tesla stock or the S&P 500 or whatever, use risk management tools and stop losses and all that stuff as we go towards the end of this bear market. And think about it this way: we think the odds of a mild recession are very high and something deeper possible. So if that's the case, look at market history. Indexes typically fall somewhere between 38 and 55%, depending upon which case you want to look at. At our worst case, we were down 26% in the large indexes. So we really haven't, even if we go back to the old low, gotten valuations to where we normally see a real bottom. And I think on top of that, you just haven't seen investor sentiment get to those levels also that, you sort of want to say, hey, valuation's good, sentiment is awful. This is probably marking that bottom that we're looking for. And again, yes, we're looking for it in the first quarter of the year. The cool thing is, or at least we do think it's cool as finance geeks, is that the new bull market, another New Year's resolution, you don't need to be as heavily in technology. And I think that that's really going to be an important thing.
I've heard that before, only for people to come roaring back into technology. Having said that, James, you've seen a lot of market cycles, more than 3 decades worth. Barron's has singled you out as a top advisor ranking. That's a good place to be, and it means, you've made some really good market calls. So in terms of this market environment, does it remind you of another? How do you see it? Is it very opportunistic for investors at this point, or another difficult one? And just got about a minute or so, minute 30.
Yeah, I think there's always an opportunity. I mean, if you owned, the healthcare companies as we have, the consumer staples this year, those were great opportunities, and they continue to work. And I think that's the most important thing. Is this a classic bear market? Absolutely. This is just a normal process. We're going towards a new business cycle. We're getting rid of the old one. It's based on inflation. The inflation will be put away. It's already working. And once that's done, we are going to start a new business cycle, new bull market. It's very exciting. I think 2023 is going to be a great year. Maybe not so good in the beginning, but going to end lovely.
All right, well, it'll be interesting to check back in with you next year as we work our way through, I guess, whatever we're working our way through. James, have a wonderful New Year's. If we don't talk to you before then, James Demmert there, helping to kick off today's program, Chief Investment Officer over at Main Street Research. A lot more here to cover on the show, but before we get to that, we want to check in on what's going on outside the world of business with the Bloomberg First Word and Mark Crumpton.
Romaine, thank you. Russia's foreign minister warns that Ukraine must surrender or face continued war. Sergei Lavrov spoke to the state-run news agency TASS, saying that Ukrainian surrender was for its own good. Lavrov's remarks came as Russian troops have been forced to retreat in a series of damaging defeats. Taiwan is sending a signal to the United States that China that it's serious about defending itself. President Tsai Ing-wen is extending compulsory military service for men from 4 months to 1 year. Taiwan has been working with the U.S. to strengthen its defenses against a potential Chinese invasion. President Biden and Senate Majority Leader Chuck Schumer are transforming the federal courts at a blistering pace. Of the 97 judges confirmed by the Senate in the last 2 years, 3/4 of them are women, and nearly half of them are women of color, including Supreme Court Justice Ketanji Brown Jackson. Just 5 of the president's appellate and district court judges are white men. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much for that update, Mark. Really do appreciate it. Coming up, we're going to continue our coverage of the massive storm that continues to make its way across the U.S. About the storm chaos continuing. This is Bloomberg.
Part of what I love about business is you get to build things from nothing. I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg Markets. Romain Bostic here alongside Tim Stenovic and Carol Massar. A look right now at the weather, at travel conditions, and all the ramifications that have arisen, of course, out of the big deep freeze that blanketed most of the United States over the past few days. Still digging out from that in the Midwest, still digging out from that in the Northeast. Madison Mills over at Bloomberg News joining us right now to talk a little bit more about what is happening and, more importantly, about, I guess, when it might all be over.
Yeah, I mean, these conditions are terrible, Romain. I know that our very own Tim Steno was in Buffalo over the holidays. Glad to see that you're okay, Tim. But it was just a terrible, terrible season of weather this holiday. Dozens killed, millions losing power. We have at least 27 deaths just in the Buffalo area alone. But when you look at the power impact here, it's honestly surprising that more people didn't lose power given just the extreme temperatures. We were at minus 50 degrees Fahrenheit across a lot of the Midwest and, of course, here in the Northeast. And we're seeing that, you know, across Texas last winter, of course, we expected that Texas is a warm area. They weren't prepared to deal with these super low temperatures. But then we saw the exact same impact here in the Midwest and the Northeast. So it begs a lot of questions about system upgrades that need to happen to prevent these kind of outages in the future.
Got to say, Madison, for the first time that I can ever remember in a winter season, a cold season, being asked to conserve energy. It happens during the summer because of air conditioning. Our power was out twice here just outside New York City. So what are we thinking about when it comes to energy infrastructure? What are we thinking about when it comes to energy supplies?
Well, supplies of natural gas just plunged the most in over a decade over the past couple of days here. We've got some numbers I want to point out. If you look at the 30-day moving average of the total U.S. output, down by 8 billion cubic feet. That's an 8% decline, which I asked, okay, what does that mean? What's the context on that? And that actually is a huge decline. Just to give you some more context on that, you saw December 23rd, 24th, and 25th, a decline of 14 billion cubic feet. That number is bigger than the entire U.S. daily export of gas. So just huge losses there. But when you look at futures gas prices, they're actually up by about less than 2%, falling a lot, of course, over the past couple of days. But this is because analysts are anticipating that we're going to get this very warm weekend coming up, a really warm December and January. So things are looking a little bit brighter ahead, and that's why you're just not seeing this deep uncertainty as we look into futures here.
Madison, I think ever since we saw that storm in Texas a couple of years ago that really froze things out in the middle of winter of 2021, I've had this understanding that we're really in this fragile system when it comes to the electrical grids here in the United States. In terms of infrastructure, in terms of updates that need to be made, what's the conversation happening right now? And look, is there actually political will at this point to make those improvements?
It's really difficult, especially when you look at these costs, because a lot of areas, especially in New England, they had to revert to coal over the past couple of days, about 40% reliance on coal because of just this vast drop-off in supply and because of a need to keep people warm over the holidays, of course, right? So there is a big financial implication to the green energy transition that's coming up here. One climate expert I spoke with this morning just pointed out that there was this jargon around the Texas situation last year that it was really just a one-off, again, because it's such a warm region of the U.S. that they weren't prepared, but in reality, we're seeing
well, we know why they weren't prepared. I mean, that's a whole nother conversation. I am curious, though, about the nature of what is happening with regards to the weather. There are some people that will look at it and say, well, it's late December, it snows, it gets cold. There are other people that do look at climate change and say that this is sort of repeating a pattern of more intense and more frequent storms. Is that the case as to what we saw this past week?
Yeah, I think you can't say that it's not when you look at this extreme weather, right? In some areas of the country, we saw negative 17 degrees Fahrenheit last Saturday. In those same cities, we're going to see 70 degrees this coming Saturday. I was in Seattle over the holidays.
That's not normal.
It's not normal. It's not normal. You're not supposed to see ice patches across, these...
Not to see the swings, right?
The swings.
The
swings. Just the extreme direction, one way or the other. It's not normal.
Well, a big thank you to Bloomberg Quick Takes Madison Mills. Catch Madison a little later today for Bloomberg Sound On at 5. Well, all that weather continuing to wreak havoc on airlines, particularly Southwest Airlines. The company canceling nearly 2/3 of its flight today, still hobbled by that massive winter storm that major rivals have actually been able to recover from. Even the Department of Transportation weighing in yesterday, saying that it's concerned by Southwest's, quote, unacceptable rate of cancellation and will investigate reports of a lack of prompt customer service. For more, we bring in Bloomberg's Leah Nyland joining us from Washington, D.C. Leah, let's go into the causes of this. Why is Southwest so much more affected than other airlines? It has to do with a lack of a hub and spoke model, right?
Yeah, so Southwest doesn't use the same model that all of the other airlines do. The other airlines tend to have a hub and the flights go out from there. But Southwest does this thing sort of called hopscotching. So it just takes a flight from like place to place to place to place. But if one of those legs ends up being canceled, then the plane can't get to the future legs, and all of those other ones have to be canceled too, which is why there's been this cascade effect where Southwest has had to cancel so many flights just over the weekend. I mean, it started on like Thursday night, went through the weekend, and now they're still seeing huge amounts of cancellations. Yesterday was worse even than at the beginning of the storm. They had 71% cancellations, and today we have, again, 63% cancellations. Ever since I wrote the story yesterday, I've just been getting all of these emails from stranded travelers actually asking me if I can help them, and obviously I can't do anything, but they keep telling me that they end up on the customer service line for hours. Sometimes it crashes, and so there's quite a bit of folks who are stuck places because of Southwest right now.
So, Leah, are you stuck in Atlanta? Actually, we're just realizing everybody's moving around right now. We're not quite sure where everybody is because people have got stuck. Are you stuck in Atlanta?
I am not stuck in Atlanta. I drove, but it has been absurdly cold here.
So let me ask you too, like you said, that because of the model that Southwest has specifically, to undo it is going to take some time, because you're saying there's going to be more cancellations tomorrow, some on Thursday. Do they anticipate anything you're hearing from Southwest about getting back to normal?
Yeah, they've been trying. They said they've been trying since Christmas Day. All their executives worked through Christmas Day. They also had this other technical problem where, they have some sort of legacy systems they're working on updating. And one of the ones that failed was the ones that the crews use to call in and find out where they're supposed to be. So there were all these crews, of pilots and flight attendants trying to figure out what flights they were on, and they couldn't get through. Yeah. So that sort of ended up causing another cascade of flights, because obviously, you have to have a certain number of people on the airline or on the aircraft to even fly it.
Yeah.
And so they've just been trying to get everything back into place. They issued an apology last night. The CEO and the COO have also come out and apologized and said they're going to try and get people refunds, but it's going to take a while.
All right. Well, good for them. I am curious, though, here, when we talk about the potential government response. I mean, we heard from the Transportation Department, or at least a tweet out of them saying that there are concerns about the, quote, unacceptable rate of cancellations. And then Joe Biden felt that he had to weigh in as well, not naming Southwest by name, but also making a similar comments. And I am curious as to sort of what role the Transportation Department would have in addressing this particular issue for this particular spate of flight cancellations. Is this something more systemic or systematic that they can address, or is this just a one-off for Southwest and the weather?
Yeah, one thing that DOT said they really wanted to look at is Southwest customer service plan. All of the airlines are supposed to have plans in place for when there are weather-related delays, when there are major disruptions. And they sort of want to look at, did you actually have a good enough plan for something like this? The Southwest CEO has come out and said, this was a once-in-a-lifetime storm. We weren't prepared for this, but, it won't happen again. DOT is actually going to look at, did you have sufficient things in place? There was already another major disruption in October of last year on Southwest Airlines. So I think they're going to be looking at whether this is sort of a repeat pattern or whether this really was a one-off.
Yeah, and we should point out, of course, you have, of course, a business model here that to a certain extent has actually helped Southwest in the past with regards to keeping their costs down, obviously backfiring against them in this particular situation. We are going to have to leave it there. Really appreciate you taking time for us today. Obviously a story that a lot of folks are keeping an eye on and watching. Leah Nyland there with the big meltdown that we're seeing when it comes to Southwest and air travel.
3 to 5% of revenue for the quarter that this could actually shave off. I wonder, though, about goodwill, Romaine and Carol, and to what
It's
extent.
not going to stop people from flying. Let's be real. Remember 2007, JetBlue, the Valentine's Day? I mean, people came back.
Good point. Lost a CEO after that, though, right?
No, exactly. And they cut a third of its schedule. But nonetheless, everybody is dying to get out on a plane.
All right, a lot more to cover. We're going to talk about what's going on in the energy sector, a decent rally that we're seeing in the energy space, not necessarily in the other commodities. Don't go anywhere. From New York, this is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Markets to close almost 2:30 here in New York City. So keeping an eye on the commodity space as we get settlement right now of what's going on the NYMEX. We talk about it being a low volume, low volatility day for equities. You can't say the same for energy. It has been an incredibly volatile day for WTI crude, which at one point on the day was up more than 2% here on that optimism about the continued relaxation of some of those COVID-0 policies in China. It rallied about 2%, but now peeling back, and it looks like it's going to settle basically unchanged on the day, back below $80 a barrel. Remember, we haven't had a settlement above $80 a barrel since going back to December 1st. 79.65 is the unofficial close that we're getting right now on WTI crude as we wait for the numbers to settle. The rest of the commodity space, guys, has been a real mixed bag here. Some optimism in the metal space with a modest rally going on in iron ore as well as in copper on the LME. And then you're also seeing some of the soft commodities like soybeans also moving higher, but some of the other ones that would also be linked to that reopening like cotton and wheat moving slightly lower here on the day.
Yeah, as a whole, if you look at the commodity space, the CRB, it's up about 1.6% in today's trade. So commodities definitely a focal point, considering that news out of China, rolling back really most of its COVID-0 policies. So let's talk and dig into the commodity space. With us is the Deputy Managing Editor and Team Leader for Energy and Commodities, Simon Casey, joining us on the, actually, is he with us via Zoom? There you are. Hi, Simon. How are you?
Hi.
Is it Zoom or is it Skype? What
is it Zoom? Is it Skype?
Teams? What's going on?
Is it the metaverse?
I believe it's Zoom.
Okay.
I think we're on Zoom.
All right, now that we've cleared that up, I think Carol has a question about commodities.
Check. How does the China news, I'm thinking about how all of the China news impacts the financial markets, our global outlook. How do you see it changing the commodity space potentially or possibly in 2023?
I think it's undoubtedly a good bit of cheer at the end of a very volatile, a very unpredictable year. I mean, look, there are two sort of broad impacts here. First, as you say, on energy. China is the world's second largest market for oil. It's the world's largest oil importer. Those imports have been under pressure ever since China went into a massive lockdown because of COVID, and that's finally been dialed right back now. So as you saw with the opening overnight and all through the day, that's really been the one positive factor in the oil market. What otherwise would have been a quiet day, it's actually been quite lively. The other impact to draw your attention to is on metals. China it consumes something like more than half now of the world's metals. So any kind of big macro change there is closely watched by the metal markets. And the London Metal Exchange is closed today, but there has been some trading on Asian exchanges, on the COMEX here for copper. Metals have been up. And then, of course, we have iron ore futures traded in Asia. Those were up at the highest since August. And, China gobbles up most of the world's iron ore, and the property sector is massively important in that economy, as we all know, and this is seen as
Simon, I am curious. So, why would we expect anything more when it comes to pricing out there? Is the idea that the consumption that we expect out of China, that level of consumption, or at least the level that the market is trying to price in, is significantly higher than where we already are?
It's going to rise. I mean, that's what the markets are telling you. That's what the price tells you. Now, whether that will actually happen, we'll see, because the picture's not totally clear. Let's be quite clear. There are a lot of people in China getting very ill at the moment. It's quite a grave situation in that respect. But I think there's an expectation that now the restrictions have been lifted. There's a sense almost inevitably people will drive more. There will be a corresponding increase in economic activity, and that will inevitably drive an increase in consumption.
Simon, let's move things closer to home, at least for us here in the United States, and talk about the deadly winter storm that continues to make its way, though the worst, fortunately, is behind us here in the U.S. To what extent has it impacted refineries, natural gas stockpiles? What do you have your eye on?
Well, we have our eye on several things. I mean, first of all, refineries. It knocked out a bunch of refineries on the Gulf Coast. I think if that had happened earlier in the year, I think it would have been a bigger story than it has turned out to be. Those refineries were, in most cases, idled as a precautionary measure. They're coming on today, we believe. We're still reporting that one out. There are more inventories of gasoline at this point in the year than there were earlier this year. So we're in I guess, a fortunate position if you're a consumer that you shouldn't see at the moment too much, if any, impact on prices at the pump. But it points to vulnerabilities there. I mean, if we're going to see more cold weather move through through Texas during this winter, this could happen again. The other thing we're watching, and it's perhaps a bit more concerning, frankly, is what happened in Appalachia over the weekend. These very cold temperatures move through Pennsylvania and that region and Ohio. They froze off many natural gas wells, and that had a knock-on effect. I think you were talking about this a bit earlier. Absolutely right. It's really a record reduction in natural gas supply. And while that supply
what's going on with that Freeport facility down in Texas? Is that reopened, or have they set a date for that?
They've set a date for the end of the year, but they're not going to make that. It's almost certain. So that in some ways is good news for consumers here in the US because it's increasing the domestic supply of gas. That's another thing that traders are watching, because that's such a big facility that the moment that gets turned on, that's a massive outflow of gas from the United States, and that changes the whole national supply and demand picture.
Simon Casey from Bloomberg News, really appreciate you taking the time and joining us this afternoon. Simon Casey of Bloomberg News. Well, what a difference just a few months makes. Semiconductor makers in the midst right now of plummeting demand for their products just this less than a year after being unable to produce enough to meet orders. The main buyers of memory chips are now stuck with stockpile components and are slowing orders for new stock. For anything to do with the semiconductor space, we always turn to Ian King. He's U.S. semiconductor and networking reporter for Bloomberg News. He joins us from San Francisco this afternoon. Ian, really good to have you with us. I want to go back to what you wrote last week about what we heard from Micron, outlining that rough road ahead to profit as this memory glut hits right now. What did Micron spell out last week, and to what extent does that affect chip makers in 2023?
Yeah, I mean, it was even sort of worse than people had feared. He basically said next year it's going to be tough. We're in this unprecedented imbalance between supply and demand, the worst it's been in about 13 years. And unfortunately, that just kind of made people were fearing things were bad, and then it got even worse. It's like, oh, really, it's that bad? And he called for lots of actions required to reduce supply and to try to bring things back in alignment, and said, that's going to take some time.
So, Ian, we always turn to you in terms of understanding the cycles. As you say, there are up cycles and down cycles, and they happen often in the semi, space. In terms of the big semi companies or the big fundamentals that impact this space, what are you watching specifically, or who are you watching specifically for an idea of what's to come?
Yeah, I mean, obviously we'll have a lot of earnings, starting sort of mid to late January, which will kind of update us on these things. But Micron tends to be the sort of canary in the coal mine because of the volatility of memory. And, this is a situation we're in. Unless you can tell us that PC demand is back and PCs are flying off the shelves again, and the same for smartphones, really the outlook for these companies is dim, because despite everything we've heard about what's coming, what's new, and we all need chips, still need PCs, still need smartphones.
Is there not another use case for some of those chips that would go into those PCs and smartphones? Is there not an adaptability that these companies have in that circumstance?
Yeah, no, you make a very good point, Romain. I mean, unfortunately, because these companies have spoken so much about auto, and they've spoken so much about IoT and industrial and everything that the world is now going to need to make us smarter, I think people have become focused on these new use cases and really lost sight of the fact that PCs and smartphones are still the giant markets for this electronic component, and we need those markets to be at least close to being healthy for the overall industry to be okay. Any
concern, Ian, that a softness in 2023 could derail massive investments by companies like TSMC and Intel here in the United States?
Yeah, I mean, that's a very good question. You've got to be reading the fine print. We've seen them come out and say, look, we're going to spend all of these billions of dollars on new plants, particularly in America, particularly in Europe. And everyone's like, wow, this is going to be huge. But if you read the fine print on every announcement, it's like, well, we're going to build the factory, but we're not going to equip it. And as everybody knows, the equipment is the really big expense, and that's what you absolutely need to put in place to have that production. So we're going to see a lot of factories get built, but we're not going to see them equipped, I think probably be the sort of sensible outlook for that.
All right, Ian, always wonderful to catch up with you. Ian King, who covers the chip space for us, and the chip space, of course, writ large, becoming quite the barometer for the economy writ large as well. A lot more to cover here on the big program, but we do want to get you up to date on news from outside the world of business. Here's Mark Crumpton with the first word.
Romaine, thank you. Russia's foreign minister warns that Ukraine must surrender or face continued war. Sergei Lavrov spoke to the state-run news agency TASS, saying that Ukrainian surrender was for its own good. Lavrov's remarks came as Russian troops have been forced to retreat in a series of damaging defeats. Taiwan is sending a signal to the United States and China that it's serious about defending itself. President Tsai Ing-wen is extending compulsory military service for men from 4 months to 1 year. Taiwan has been working with the U.S. to strengthen its defenses against a potential Chinese invasion. President Biden and Senate Majority Leader Chuck Schumer are transforming the federal courts at a blistering pace. Of the 97 judges confirmed by the Senate in the last 2 years, 3/4 of them are women, and nearly half of them are women of color, including Supreme Court Justice Ketanji Brown Jackson. Just 5 of the president's appellate and district court judges are white men. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
All right, Mark, thank you so much. Mark Crumpton there with Bloomberg First Word. And if you take a look at some of the stories on the Bloomberg today, this is what we call a spotlight story. And it's an interesting one, and it has to do with Amazon and basically many of the packaging that we all see that show up on our doorstep and make their way into our homes. Well, Bloomberg Green retraced a trail back from the industrial belt of northern India through the brokers who ship refuse around the world. And basically, the bottom line, guys, on this is that these packages, which are supposed to be recycled, say recycling on them, are ending up in northern India. And it's turning out to be their garbage and their problem, which is not a new story, right? We see this often.
It's not. This is a fabulous piece of reporting. And I've seen other stories like this, not specifically focused on Amazon, but the idea of tracing what we are recycling or what we think we're recycling, right? And where it actually ends up. And this is one of those stories where, unfortunately, you find out that where it ends up is maybe not what we had intended.
Right, and one of the big issues here is the mixed use and mixed materials that these packages actually have in them. If they're paper in addition to plastic, it limits where these things can be recycled. And the concern, of course, is, as consumers, the way our shopping habits have changed over the last few years, particularly during the pandemic, we're ordering more and more when it comes to e-commerce, despite the slowness that we heard from Amazon about growth in the current quarter that we're seeing right now. But the fact is we order so much, and it costs the companies a lot of money, which they make up for with what they sell, but also the environmental toll is huge, whether that's the last mile delivery or whether the packaging and materials is not actually recycled.
But there's a broader question here too, I think, just about, I think, some of the green initiatives that whether we've taken on personally or whether corporations and governments have done, and the idea of whether it's living up. But there's been obviously a lot of talk about EVs and how they're not as clean, at least in terms of making them and making the batteries. Obviously the emissions aren't there. But there's also the same issue with the recycling, that a lot of the recycling that we think is being had at hand and maybe ends up fueling more consumption because we think, hey, well, that box is just going to get recycled.
I was listening to a story this morning about retail specifically and how it's gone from, maybe getting it in a few days to overnight to maybe getting it in hours. And I'm like, doesn't that go against the green initiatives that we're all thinking about? I don't know about in your households, but we are now saying, okay, we're going to try and make 1 order a month when it comes to Amazon because it's just gotten out of hand.
This is what Mark Lorry was trying to solve when he started Jet.com a few years ago. It didn't ultimately work in terms of, it worked as an investment and it worked to make him incredibly wealthy, even more wealthy than he already was. But the problem is we've been conditioned to buy these one-off products because it is easy and it is cheap, Romaine.
Yeah, and the packaging matters too. I mean, you order, unfortunately, not to pick on Amazon, but if you order 5 things from Amazon, unfortunately, they often come in 4 different boxes. Even when you check that box, it says, put it all in one. But anyway, a lot to reckon with here and a great read on the Bloomberg terminal. Taking a closer look here at recycling, or rather the lack thereof, of some of our packaging here. A lot more to cover on the show, including the further relaxation of those COVID-0 rules over there in China. This is a big deal. More movement for the folks in China and potentially more movement for foreign nationals who want to travel to Hong Kong and other places. We'll be back in a moment. This is Bloomberg.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became prime minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Well, the first of the final 4 trading days of 2022 here, and well, it's pretty much more of the same. Much of what we've seen for a good portion of the year are short bias and defensive posturing. That continues to be the positioning here as we close out the year. Modest losses here on the day with the S&P 500 down about 0.5%. Much more steeper losses that we're seeing in the tech space here with the NASDAQ down about 1.3%. A big drag, of course, coming from Apple and Tesla. Tesla down right now 8.6% here on the day. And this is really going to go down, guys, as one of the biggest destructions of shareholder value that we've seen, at least among a company of this scale and size. A company that I think by all intensive measures, most people think should not have seen these types of declines if it weren't for the antics, I guess, of a certain executive.
Well, almost giving away all of its gains that it made during the pandemic. I mean, we're talking 2-year lows at this point right now, Carol.
It's pretty remarkable. Remember when this was, what, a $500 billion stock, and that was just, what, a month or so ago, or a few weeks, it's not so long ago. And you do wonder what comes next for this company in terms of shareholders and activist investors.
Yeah, absolutely, and there's going to be a lot. And in fairness, of course, to Elon Musk, we should point out there are some broader issues in the EV space, and you're seeing Rivian and Lucid and some of the other names being dragged down. A lot of concerns here about, well, demand, and then, of course, about competition. So this isn't just a Tesla story. This might be a reckoning for the EV space as a whole.
Well, the catalyst today is concern over demand in China. And sticking with China, though, a different story. The country is set to scrap its quarantine policy for incoming travelers. That starts in just a week or so, June 8th. Bloomberg's Alan Wan has the details.
COVID infections are soaring, hospitals are being overwhelmed, and deaths are rising after China dismantled COVID-0. The National Health Commission said that it's going to stop reporting official numbers, but we do know that at least 18% of the population was infected during the first 20 days of December. That's according to the minutes of his latest meeting. The Chinese government also said that it's going to downgrade its management from the highest to the second highest. And it's also going to increase supply of life-saving equipment such as ventilators, ICU beds, as well as retrofit quarantine facilities into hospitals that can treat COVID patients. And behind me is one of the nation's biggest online travel platforms. It's going to benefit a lot after China stopped its policy of quarantine overseas arrivals from January 8th. Right now, it's about 5 days of quarantine in a hotel, and then 3 days of home monitoring. And I personally have done 2 long quarantine stays, one for 14 days and one for 10 days, and I tell you, it's pretty brutal. So I look forward to the end of this policy.
And a big thank you to Bloomberg's Alan Wan for the details. A quick correction, I said June earlier, I meant January 8th is when China is set to scrap its quarantine policy for incoming travelers. Carol.
All right, so let's move on because we did get some economic news today. Go figure, some on how home prices, retail inventories, also some trade data in particular. So let's get to it, and let's talk to Jeanette Garrity. She's Managing Director, and she's Chief Economist over at Robertson Stephens. She joins us today from Menlo Park, California. Jeanette, good to have you here. here on this Tuesday. The economic news that we got today, what in particular stands out for you?
Well, actually, the trade deficit, the trade numbers are really, really interesting. It was a big narrowing of the trade deficit. It was the largest, a little bit more than 15% decline in the trade deficit that we've seen in years, and the lowest trade deficit since the end of 2020. And it shows up, it comes to pass because of a decline or deceleration in exports. In imports. Imports, yeah. Exports went down as well, but not as much. And that fits this narrative that the U.S. consumer is pulling back on goods and services spending. That is what you would expect to see. But it's a notable number. I realize we're focused a lot on China this morning for all the obvious reasons. But there's also a slowdown going on elsewhere.
Oh, yeah, Jenna, I'm totally on board with you. When I saw that drop, it was something like 7-8% here. And obviously, this is just one data point. But I am curious that when you sort of look at your experience over the years, over the decades, when we start to see these types of numbers come down, import numbers come down here, is that typically indicative of economic pain or economic pressures, or is there something else at work?
Well, it can be moved around these days by things like oil prices and energy flows, commodity flows. But I think in this case, I'd say 95% of the time when you see a movement like this, it almost always traces back to the U.S. consumer. Consumer spending rising a lot, you tend to get an expansion in the trade deficit, and the opposite happens as well. So it's an interesting big story, but I think for many of us, it's a confirming signal on some of the slowdowns that we've been seeing in November, in contrast to October on the consumer spending side. Again, much of that concentrated on goods and services. The other issue in play has already been referenced by your previous speakers, which is the order book for businesses is moving all around.
Jeanette,
and so, that's notable too.
Jeanette, though, isn't this what the Fed wants to see? Isn't this what Jerome Powell wants to see? A pulling back so inflation will ease, so it'll come under control?
What does Chairman Powell want to see? These days, he seems to want to see a pullback in employment. So, he's not going to go out there and say, I want to see the economy decline. That's not really what he wants to say. So what he's saying is, I want to see a pullback in employment. He's not really tracking it to...
Okay, can you tie this data to employment at all then?
Well, this is a remarkable economy on the employment side. The employment numbers, which will come out on January 6th for the month of December, will be very, very interesting to watch, but I don't think they're going to show a lot of pullback yet. Maybe the most interesting month is going to be January, because that's when the decisions of businesses to cut labor force really will come into play. So we'll see. But there's still a lot of demand.
Yeah, there's still a lot of help wanted signs out there. And what's interesting is, I'm just looking at the nuances of the data. Imports of consumer merchandise have fallen from a record earlier this year. They still, though, remain well higher than the pre-pandemic average. So they are high. So we need some perspective. I mean, how much of this data point potentially is inventory working down some of those inventories? We're seeing that with the retail space, no doubt about that. And also, just again, for U.S. consumers, they're shifting from goods to services specifically. So I do wonder about the nuances of this data.
Absolutely great points, and especially inventories. I think when we look at some of the numbers that are being reported out from some of the real-time GDP trackers that show very strong growth in the fourth quarter here, some of that is inventory build that occurred in October that is still a reflection of the weirdness of the supply chain. Finally, as the supply chain improves, you start to get these orders coming in that go into inventory. But I think we start to see in this month and already at the end of November some drawdown in those inventories. And so that's definitely a factor.
I want to get your thoughts here about what we've been seeing in the housing market. I mean, obviously, the effects of what the Fed did in 2022 has already been seen there, and we continue to see significant drops in home prices, or home price growth, I should say, including the most recent data that we got this morning. The sense here that maybe certain things have been right-sized. Are you seeing it that way?
Maybe starting to get right-sized. I don't think we're there yet. That Case-Shiller number that we got this morning, the way it's calculated, has a big lag in it. It's really looking backwards in a significant way. I think there's going to be quite a bit more in the way of price declines. Building permits have fallen almost 30% in the United States since June, and so the home building is going to fall off. That's where the Fed interest rate impact is really hitting significantly, and we cannot underestimate the degree to which home sales drive consumer spending.
Absolutely.
And even services, landscaping, all of this kind of stuff gets tied to that. So it has a big impact on the economy.
Yeah, absolutely. Well said, and really great to catch up with you. Great insights here out of Jeanette Garrity, Managing Director and Chief Economist over at Robertson Stephens. And guys, look, this is a light week for economic data. Next week is going to be huge. Of course, we get the jobs report at the end of next week, the FOMC minutes, and a few other things. The question is, what's the trend line that we're going to see? Is it going to be a continuation, I think, of what we've seen over the last couple of months, or something different?
I think we're going to continue to see weakness. And I think the home story and the home price story and just the home activity coming down is a big deal. And it's a real reduction when it comes to U.S. economic activity.
Driving to and from Western New York, I looked for data, anecdata, as I call it. $20 an hour at Denny's. There was a sign, and then now hiring at a big FedEx facility in Pennsylvania as well.
Well, I mean, you know, that's good for a lot of folks out there. I mean, of course, that's not necessarily what Jay Powell wants to see, but, you know, I'll say this. Jay Powell ain't the economy.
That's a good point.
This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Vietnamese consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
The top names at the Fed are on Bloomberg.
I do see growth slowing.
But remember, that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Markets, the close. Look, about an hour left here in the trading day, and we should point out, of course, coming off of a holiday shortened week. This is a holiday shortened week, I should say. Of course, sandwiched in between Christmas and New Year's, volume is significantly light as it tends to be here, so don't read too much into the price action. But it is a relatively tepid day here with the S&P down fractionally on the day, and most of the losses that we're seeing among the big cap tech names, and that's pushing the NASDAQ lower by more than 1% here on the day. One of the few bright spots, believe it or not, if you're into price-weighted indexes, the Dow Jones Industrial Average, Carol, up about 0.1%.
You don't care about the Dow Jones Industrial Average.
I don't care about the Dow Jones Industrial Average. But Boeing, how about that? I care about Boeing. Boeing's in the Dow.
And it's a good indicator of what's going on in the economy. We saw some big orders, right? Or a big order, I should say, late in the year. And, you know, you're not going to place that order if you're an airline unless you feel confident about the outlook.
Apple, we got to talk about Apple. 130 right now and change on Apple. That's down 1% on the day. But this has been a weird move. It's down for a third day, and it's down something like 12% since the start of this month. And I think today we're hitting a fresh 52-week low. And I guess some of this has to do with China and the lack of demand maybe that we saw for the iPhone 14 and the idea that maybe there might be more persistent issues because of all the lockdowns here. But when you look at this on a valuation basis and you sort of stack it up against some of the other big cap tech names, you would think it would be an outperformer. But it's actually one of the bigger underperformers, at least among the large cap tech names.
Yeah, down 26.66% right now. It's still got that market cap over $2 trillion. It is outperforming the benchmark, though, the NASDAQ 100, at least on the year, Romaine.
Yeah, absolutely.
But it also explains one of the big drags, right? On certainly the NASDAQ, but even the S&P, it's more than 6% of that index. So you understand why what Apple does sways the market, the overall trade.
Well, we already know what's going to be a top story in the new year. Everything that has to do with China, including what Apple is doing in China. But it's not just that. It's about the U.S.-China relationship as well. And then the news that we got overnight that we've been talking about throughout the program. China reopening its border to the world, removing the last of its COVID curbs. With a roundup of this and the relationship between the two largest and most significant economies, let's get to Jordan Fabian, Bloomberg News White House reporter. Jordan, good to see you this afternoon. What have we heard from the Biden administration about travel between the U.S. and China and what it means for U.S. nationals now that China has removed many of the curbs that were in place for incoming visitors into the country?
Well, the Biden administration has signaled they're not planning necessarily any new measures in response to this opening by China. So even though there are now fewer rules for people from the U.S. to enter China, they're not necessarily going to do anything, even though there's still a rising caseload there. But that being said, I mean, it is a sign that China is bringing down these measures and that it'll be easier for people from the U.S. to travel there. And so it's a new era, I know, for China and the pandemic, and also it's happening at the same time that the two governments are trying to get their relationship back on track.
What does that mean specifically, Jordan, back on track? Does it mean still a contentious relationship between the U.S. China, one where they are both wary of one another, or one that realize how they need each other going forward?
I think it's a mix of both. There's going to be significant tensions, as we saw with the U.S. response to these military exercises that China carried out near Taiwan. Those aren't going away. But if you recall back to August, after Speaker Pelosi went to Taiwan, a lot of the routine communications between the U.S. and China were severed. They were cut off. They were not talking about issues like climate or trade, and those are trying now to get back on track after President Biden and President Xi Jinping had a summit meeting a few months ago. We expect a few key key meetings here in the new year to try and make progress on some of those issues.
Yeah, well, I mean, no one in the markets really thinks that we're going to see any sort of normalization of relations, at least not as it was prior to the pandemic and really prior to the Trump administration. Probably one of the biggest elephants in the room, Jordan, really has to be Taiwan and the U.S. approach to Taiwan. And of course, the latest news about the conscription for military service for Taiwan citizens and a change in that service mandate that the White House itself is applauding.
That's right. You mentioned that statement that the White House put out a few hours ago. And look, it's a sign that the White House is clear-eyed about the situation here, is that while they're trying to get this relationship back on track, officials still see a risk that China could launch a military strike, if not now, in years into the future, and they're trying to prepare for that and also encourage Taiwan to prepare for that. In addition to this statement on the conscription, there were some year-end spending bills that approved $2 billion in immediate military aid for Taiwan and up to $10 billion in the future. So the White House really seeing that their military needs a lot of help to guard against the Chinese threat.
Hey, one last thing in terms of any new real news out of D.C. and the White House regarding China, anything that you're expecting that we should keep on our radar for January?
Well, there's going to be some meetings, as I mentioned. I think everyone's looking for a date for Secretary of State Antony Blinken's trip there. That's something that the president announced after his summit meeting. They're going to follow up on some real key issues in that meeting. So I think all of us are looking to see when that trip happens. And Secretary of the Treasury, Janet Yellen, as well, expected to travel there in the new year.
All right, Jordan, we're going to leave it there. Jordan Fabian, just outside the White House, of course, covers the White House and all things D.C. for us here at Bloomberg News. Jordan, thank you so much. We want to stay with our coverage of the markets and think about it from an international perspective. Joining us right now is Benjamin Mandel. He's head of portfolio strategy at Itaú Asset Management. Benjamin, nice to have you here. I am certainly, and I think my colleagues, just a rethink of the news out of China. How does it change the outlook for a global investor, if at all, in your view?
Okay, well, I think there's a very important point to be made with regard to emerging markets, where China is a big contributor to the overall index in equities and other assets. EM is, in our view, a structural allocation in global dollar-based portfolios. But it's been a very rich discussion, at times a controversial one this year, and definitely a change in tone with regard to the last 15 years or so. If you could take yourself back, emerging markets, and China specifically, were essential exposures to the world's growth engine, and that was sort of received wisdom a while ago. And then what happened is two things. First, there's a massive underperformance of EM assets. So MSCI EM was a 2% per year return on average versus S&P at 9%. And then more recently, and as you've been discussing, over the last hour or so, U.S.-China relations have pushed Chinese assets and EM assets in general into what we might call a value trap. That is to say, the asset class is cheap, but has continued to get cheaper. So as we look forward here, and given where we are today, I think there's actually more good news than bad news vis-a-vis emerging markets, and I think it's still a structural exposure in portfolios. For one, emerging markets is a more mature asset class than it used to be, and therefore average growth out of the region is going to be a little bit lower, but more of that is going to pass through to investors. And then vis-a-vis this whole discussion of value traps, in our analysis of historical experiences with emerging market value traps, they're not that uncommon. So EM has gone through 5 or 6 of these types of experiences over the last 20 years, and we're already seeing signs that were coming out here. So net, I think we're still invested long-term EM.
But emerging markets are not a monolith. Russia is not China, is not Brazil. They're all unique in their own ways. So if you were to think about asset allocation to the extent of which emerging markets people should be focusing on for 23, which ones should they be?
Sure. Well, I mean, there is a prevailing narrative out there right now that the second half of 2023 is going to look better for China in particular. In other words, you've had all this news telescoped into the underperformance of the last 12 months or so. You've had COVID restrictions in the short term, you've had regulatory drag in the medium term, and then the whole decoupling and deglobalization narrative in the long term. And so in a sense, underperformance itself is not monolithic. It reflects a variety of factors. And, looking at next year, will at least one of those look better in the future? Probably. And so there's kind of a looming optimistic scenario. And as we think about our global asset allocation and equity space, I think EM has to be that option for the upside. Some of that, there will be some exposure, even in the context of an overall more defensive portfolio.
But look at it, just to kind of piggyback off of Tim's question and look at it more from a risk-adjusted perspective here. I mean, obviously, there's a reason why so many people focus on China and some of the EM nations that are directly, at least geographically, in China's orbit. But there are also a lot of people that would look to Latin America, where your company's based. They would even look to some of the nations in Africa here. Is there a sense here that while you may have smaller economies there and maybe less consequential relative to China, that they might offer a better risk-adjusted investment opportunity?
Well, I think the name of the game in the global multi-asset space is diversification. That's one of the main benefits of getting into multi-asset products in the first place. And I think there's a bit of a symbiosis between emerging markets and the U.S. in that sense. So Itaú, as you mentioned, is a Brazilian bank. And as we talk to domestic investors here, we talk about the very significant benefits of holding dollar assets from the perspective of a Brazilian investor. I think it also goes the other way. If you're looking at a dollar-based portfolio and you're looking at some of the real interest rates in Brazil, for example, those are highly complementary and oftentimes quite idiosyncratic to developments in the U.S. So Brazil marches to the beat of its own drum, oftentimes for better or for worse.
Yeah, that's
and no matter what, it is idiosyncratic and does provide that diversification.
Benjamin Mendel, Head of Portfolio Strategy at Itaú Asset Management, joining us this afternoon. Really appreciate you taking the time. Well, let's go around the world for an update on news from around the world. Here's First Word with Mark Crumpton.
Thank you, Tim. Vladimir Putin is striking back over the price cap imposed on Russian oil. According to a decree, the Russian leader has banned the export of oil and oil products to foreign buyers that adhere to the cap. A group of 7 industrialized nations imposed the $60 per barrel limit to punish Russia for invading Ukraine. Power grids in Western Europe will get a break going into the new year. Warmer temperatures will reduce the strain on energy systems, which were stressed earlier this month by the first cold snap of the winter. Forecasts call for a high temperature of 16 degrees Celsius in Frankfurt. That's more than 10 degrees higher than the 30-year average on New Year's Eve. Japan will now require negative COVID-19 test results for travelers coming from China. Prime Minister Fumio Kishida told reporters that the policy will take effect from December 30th. Those who have been in mainland China within a 7-day period will be required to undergo testing upon arrival. The change comes as China throws open its borders and abandons its COVID-0 guidance. President Biden has declared a state of emergency in New York, where a massive storm dumped more than 4 feet of snow on the city of Buffalo. At least 28 people have died in the region. Meantime, Southwest Airlines is still struggling with the nationwide effects of the storm. It canceled almost 3,000 flights Monday. The carrier expects the chaos to last a few more days. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much for that update, Mark. Really do appreciate it. Carol Massa, Romaine Bostic, and Tim Stenevec were live in the Bloomberg Interactive Brokers studio. In just a few minutes, we are digging into today's big take, $1 trillion in terms of profits over the last decade, Romaine, for the 6 biggest banks here in the U.S.
It's not the Tesla market cap, I don't.
We're talking profit here.
Yeah, and that's not a surprise. I mean, we've had this conversation so much, how well these banks continue to do, yet they always seem to be so glum. I mean, why is Jamie Dimon so glum?
Cutting jobs.
I mean, they're making so much money.
Cutting bonuses for some.
I don't get it.
We're going to dig into it. It's the Bloomberg Big Take. We're coming back on Bloomberg Markets.
Maybe it's because their valuations haven't ever actually recovered back to those sort of pre-global financial crisis levels. There's a reason,
Good point. It's a good point. All right, we're coming back with that story. The Bloomberg Big Take right here on Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
All right, a lot of great stories on the Bloomberg terminal. And, well, we bring them to you here on Bloomberg Television and Radio. This one, well, it's focusing on the banks, the big take of the day, and how the U.S. banking giants, well, despite all the trouble they saw over the past decade, they scored $1 trillion of profits. That's a record.
It's a lot of money. It certainly is a record. And on that story is our own Bloomberg's Hannah Levitt. This story is among our most read, and it is the Bloomberg Big Take. So let's get to Hannah. She's on the phone on this Tuesday. Hannah, just put it out for us. It sounds like a lot of money. It sounds like these big banks on Wall Street are doing fairly well.
Yeah, so thank you guys for having me. You know, it's really interesting. When I think about, writing this story, the thing that struck me the most is that Max Ableton and I actually teamed up a few years ago at the end of 2018 to write the story that these big six banks finally hit $100 billion in profit for that 1 year, right? So when I realized it was $1 trillion for the decade, or when we realized that we were struck by, I guess, the speed with which from that point at the end of 2018 to now, how much they've made.
Well, I am curious, Hannah. I mean, I was looking through your story, and we talk about sort of what I think a lot of people would have looked at in 2018 and said, okay, this is probably the peak, or at least the peak for that cycle. And then to see that reacceleration in 2021, and then, of course, obviously this year here, what was behind that?
Yeah, absolutely. So, I mean, if you just look at that period, you know, the story in 2019 was all about the consumer and the bank's consumer engines driving profits. And, you know, I believe at the time deal making and trading were both somewhat muted. And then you have the pandemic and the markets are going crazy. So the trading desks do well. And then there's, a spree of debt and equity underwriting and deal making that goes on. And so those areas of the bank do well. And now with interest rates rising, the banks are making a lot of money on their lending businesses. So it's really, the house always wins.
Hey, Hannah, what do you think certain regulators think about this idea of $1 trillion in profit over the last decade? I mean, I have certain people in mind.
What do they think?
Like Elizabeth Warren, for example.
Shouldn't they see stability, Tim?
I don't know. I mean, what have you heard, and what has your reporting told you about the way that, this is being received in Washington?
Yeah, I mean, there are a couple of different, I guess, arguments you could make here. But when you look at the decade as a whole, it's really remarkable that, at the beginning of it, banks were very much the subject of a lot of public ire. They still are, but not nearly as much. It was right on the heels of Occupy Wall Street, and Dodd-Frank was still being hammered out and all that. And the debate of too big to fail was ongoing. And these banks have gotten bigger. They've gotten more profitable.
Hannah, is this a story of just, man, we've seen a lot of consolidation, or did, coming off the financial crisis. And so these big banks really own it and, get to consume so much of the business when it comes to M&A, when it comes to trading. Because what's interesting is I'm thinking even a Wells Fargo, which has had so many problems over so many years, and yet it is on track to make more profit over those 10 years. I mean, that to me, we're going to talk about trust later with an author and a consultant over at Deloitte. Yeah. I mean, it's kind of interesting when you think about so many consumers maybe don't trust Wells Fargo like they used to. How is this possible? Is it just a case that it's just fewer and they're bigger?
Yeah, I mean, when we looked at the decade, prior to this one that we're writing about, even with the kind of predecessor firms that got rolled up into, like for JP Morgan, it would be like Bear Stearns and Washington Mutual. You know, this decade was more profitable than the last one, even when you factor in that. So certainly consolidation is a part of it, but it's not the only part of it.
All right, Hannah Levitt on today's Bloomberg Big Take. You can check out at Bloomberg.com. Also, just type in NI Big Take on the Bloomberg terminal. Really appreciate you joining us this afternoon, Hannah Levitt from Bloomberg News. Well, from banks to the future of the U.S. telehealth industry. It's in the balance right now. U.S. officials are mulling a permanent rule change to let online startups who write prescriptions for controlled substances, well, what ends up happening in the new year? Let's break it all down with Bloomberg's Caleb Melby. Caleb, good to have you with us this afternoon. You've been covering this, what, for almost a year at this point?
Yeah, we have.
Back in March of this year, you and our colleague, Polly Mosens, wrote about the SoftBank-backed Cerebral.
Yeah.
And how things have changed over, you know, in just a few months. It's not just about Cerebral, it's about other companies. Lay out what happened and the change that U.S. officials are mulling.
Yeah, it's been quite a year. Cerebral came out in 2022 with money from SoftBank. They were becoming the biggest prescriber of controlled substances like Adderall, Xanax, and Klonopin online. After we wrote that story, the DEA started interviewing employees. A U.S. attorney issued a grand jury subpoena alleging potential violations of the Controlled Substances Act, and Cerebral stopped prescribing those sorts of drugs online. But there's other companies in this industry. They would like to hold on to Cerebral's mantle, but they are still essentially operating in what could end up being a regulatory window that closes. If the public health crisis ends and there's no new rules that allows them to do this permanently, they could find themselves not being able to prescribe to their patients anymore. So there's a mad rush in D.C. For a regulatory rollback or rule change that would essentially allow these companies to continue to practice medicine as they have been doing in perpetuity.
Isn't this the future of medicine, though? I mean what exactly are they going to roll back? I mean, we're going to have to go back to the Stone Ages and just go to the shaman and in person to get our stuff. I know this was an outgrowth of the pandemic, and it made sense. But this was also sort of in the works, maybe not necessarily for controlled substances, but telehealth in general,
right?
Before the pandemic. So why will we go backwards?
Yeah, so the interesting thing is you know, you could go see the doctor for a sore throat or something like that for many years now, but for the last decade and change, you haven't been able to get certain highly regulated drugs online. And that's actually despite the fact that
you're not getting them online. You're speaking with the doctor online, and you still have to go to a pharmacy.
Yeah, that's right? Well, some of them ship them to your door. That's part of the value add. Yeah, but they're hoping to change it so that that type of, you know, more regulated, potentially riskier form of medicine can be done online the same way we've been doing all of our other telehealth.
Right, because the traditional method worked so well. If I think of OxyContin, and I'm just saying, like, there can be problems, and so I guess what everybody's saying, let's get some safeguards in place to make sure the clinicians are who they are and the patients are who they are.
Yeah, that seems to be the problem. Is a lot of appointments are happening quite quickly, and a lot of the nurses that we've spoken to at these firms have been raising red flags all year. And it seems like that seems to be the potential place where we may reach telehealth in all forms, including for this sort of medication, but with regulations that make sure it's done responsibly and safely.
What would those regulations look like? Because I've seen reporting, not just from our team here at Bloomberg, but from other organizations as well, that have really been, they've been incredibly sad, given that people have died as a result of overdoses or perhaps contraindications when it came to different medications. And it seems in some cases, some companies haven't necessarily seen red flags when it came to addiction.
Yeah, that's the remarkable thing, is the exact same law that banned this sort of prescribing online before the public health crisis set out to create a special registration where the DEA would allow people to apply to be able to do this online, specifically for Suboxone and other treatments for opioid addiction. And the DEA just never made those rules. So there was never a special registration created at all. So, like, everybody, including the new companies we've been writing about this year and other people who have been doing other forms of telemedicine for the past decade, are waiting on these rules and waiting and waiting and waiting.
Do we have any sense as when we get somewhere on them?
No, both OMB, Office of Management and Budget, and the DEA punted when Pauly reached out to them for clarification on when those rules might.
And just real quickly, I mean, not to get too deep into this, but are there loopholes for some of these companies? I mean, there always seems to be loopholes where they can continue operating. Does one exist?
Yeah, well, I mean, I think the biggest tailwind that they have going for them right now is that hundreds of thousands of people over the last 2.5 years have started getting medications this way, and that just creates a lot of a lot of gravity to try to figure out a way to make this.
Especially when it comes to rural communities, right? This is something we talked about a lot in COVID or during COVID when telehealth really kicked in and providing access to those who were often left out. Caleb, thank you so much. Really appreciate it. Story by Pauly Mosens, our Caleb Melby, though, breaking it down, and you can find that story on the Bloomberg. We're coming back. We've got more right here on Bloomberg Markets. Carol Massar, Romaine Bostick, and Tim Stenovec. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, a Tuesday afternoon, a holiday-shortened week. More of the same as to what we've been seeing, really, over the past few days and weeks. If you're looking for a Santa Claus rally, you're not going to get it today. The S&P down about 0.2%. The NASDAQ indices down by more than 1%. One of the few bright spots out there is the Dow Jones Industrial Average and Dow Transports, but they're only up fractionally here on the day. Airlines lower, SPACs lower, retail stocks lower, chip stocks lower. And if you're looking for any bright spots out there, you can find them, well, in bank stocks. We were just talking about that. The KBW Bank Index up about 0.4% here on the day. And, well, and I know you know this already.
What?
Your Chinese stocks, your Chinese ADRs also doing pretty well. Alibaba up 5% on the day.
Yeah. All of those Chinese ADRs topping the NASDAQ today.
Yeah.
One asset class you did not mention, Romaine, is crypto. It is
that
lower as a whole. It is, yeah. Bitcoin down about 0.9%, but holding firm at 16,677 right now.
Wow.
Let's get the latest
When
on
does it get back
crypto,
to 60,000?
Oh, I have no idea.
Or a million.
No idea. Kathy Wood might have the answer
Forecaster
to
out there.
that. Federal prosecutors are investigating right now an alleged cybercrime. It drained more than $370 million out of FTX. This was just hours after the crypto exchange filed for bankruptcy last month. The Department of Justice launching a criminal probe into the stolen assets that is separate from the fraud case against FTX co-founder Sam Bankman-Fried. This according to a person familiar with the case. Writing about it today and with us on the latest and the ongoing story from the Southern District of New York, we've got Bloomberg's Ava Benny Morrison. Ava, good to have you with us this afternoon. I remember this playing out on Twitter as it was happening. It was kind of mind-boggling to see that people were tracking this more than $370 million in cryptocurrency that was stolen. What do we know and what did we learn today?
That's right, and it seemed to sort of get swept up in everything else that was happening with FTX. But we've learned today that federal prosecutors are now investigating the source of that hack. So this happened on the night of November 11 when FTX formally filed for bankruptcy. And you're right, a few people on Twitter started noticing some suspicious transactions that were happening. And there was about $370 million worth of assets that were siphoned out of FTX that night. And so over the past month or several weeks now, federal prosecutors have been working with a crypto analysis firm to try to track the funds, looking at them going through mixes to different platforms, exchanges, and trying to leap on them when they can to stop them being distributed further.
Ava, how possible is it that it's an inside job? Somebody was familiar with what was going on, considering the timing of this?
Well, that's the big question, really. Prosecutors at this stage don't know whether it was someone on the inside. An interesting point is that Sam Bankman-Fried, before he was arrested, in various media interviews, was suggesting that it was a disgruntled ex-employee who had gotten into the system before just after the company filed for bankruptcy. But investigators haven't been able to confirm that yet. They're also not ruling out that it is someone external that was just taking advantage of a company that was falling to pieces.
A couple of questions here, Ava. So explain to me, so the $370 million that we're talking about here, is this different from the $8 billion shortfall that Sam Bankman-Fried kept referring to at the time of the collapse?
Yes. So the $8 billion was the amount on the balance sheet, essentially, that wasn't there. And it's the amount that's still missing. The $372 million was the amount of crypto assets that were on hand that were hacked out of FTX.
So is the idea that there was such a fog of war amid the bankruptcy filing, amid this collapse, that somebody, whether externally or internally, was able to sort of spirit off $372 million worth of these assets?
Yes, and the new management at FTX who are overseeing the bankruptcy have also made that point.
Was this actual fiat currency, or was this crypto?
It was crypto. It was tokens.
Is there not sort of a ledger that keeps track of all this stuff?
That's a good question, and the people that were running at FTX now have made a point of saying that a lot of these record keeping and these corporate security measures just weren't in place at FTX, which suggests why it may have been easy for people to get into. Exactly.
Yeah, it's pretty remarkable to hear just in the last 2 months about the lack of controls at the company. So perhaps this is not too surprising to many people who've been following closely. So Ava, what's the end game here? Go ahead.
Go ahead, Tim. Go ahead.
Yeah, what's the end game here? I mean, are prosecutors, based on who you talk to, are they going to be able to find this money? And if they do, does it just end up going to creditors?
Yes, well, that's the end game, really. Prosecutors want to know who the hacker is, how they ended up cracking into the FTX system when the whole estate was essentially supposed to be frozen and no one was supposed to move anything in or out. They want to know who that person is, where the money and the assets have gone, and they want to try and freeze that stolen crypto so that they can return it to the FTX estate, and it can be added to the pool of assets that hopefully one day will be distributed to repay creditors.
All right, Ava, well, great story here. And of course, the never-ending saga right now of FTX getting even more complicated with the search for that $372 million that vanished in that hack. Ava Benny Morrison writing a great story today. And I think it was you who said it, Tim, or maybe it was Carol, the idea of sort of the lack of controls. And this seems to be the real narrative here. Because we can talk about what Sam Bankman-Fried knew, what he didn't know. At the end of the day, it didn't appear there was a lot of oversight by anyone.
No, I think that's one of the big themes that we're finding out. And, you had a new industry growth. I mean, certainly crypto had been around for a few years, but it's really come into its own the last couple of years. And where were regulators to maybe understand or have the checks on this? But the other thing is, these were people who understood, the financial markets and how things are supposed to work. So
MIT,
where was the
Stanford,
oversight?
Jane Street alums.
Yeah.
Right, I know he's playing dumb, but I mean, you don't have his type of pedigree unless you're an incredibly smart individual. And that goes for the other executives who were there right alongside him, two of which who I think are going to be testifying against him. I am curious, though, Tim, I think you understand the crypto world certainly better than me. I thought there was a way to keep track of that. Like, even if you don't know if someone spirited it off into a cold wall or something, obviously you wouldn't know at the end, but you would have some sense of the initial transaction that took it off of FTX's or Alameda's balance sheet to wherever it went. Why is that not available?
It's a really good question. You heard Ava in one of her answers there use a term called mixer. And a mixer is a way that people can provide anonymity when it comes to how they move cryptocurrency. I don't know exactly how they work, but it's one tool that people can use in order to try to obfuscate who's actually responsible for it and who it belongs to. It also, of course, depends on the type of crypto and what that ledger looks like.
Wasn't that, though, what crypto was supposed to be about? That you had a digital record of all these transactions, which was the upside to it, but then there was also there was supposed to be complete transparency.
Right. But the whole collapse, and it's not just FTX. I mean, we talk about Terra Luna, all the other collapses that we had this year. They all seem to have suffered from one of the same things, which is lack of transparency. The idea that a lot of these were centralized exchanges. They weren't very transparent about where the money was or where it was supposed to be.
Right.
And I mean, the whole point of at least Bitcoin and the creation of Bitcoin was this idea of having that transparent decentralization.
I think what's interesting is that within the crypto space, you had these companies that weren't just a pure play, like increasingly with FTX, that there were all these other entities, and then there obviously weren't the walls between all of them, and things got a little messy, dirty, and a lot of money was lost, no doubt about it. All right, we're going to talk maybe about the more traditional markets, so let's get back.
Traditional finance.
Yeah, traditional finance. Wow, something new, right?
TradFi.
Something old. Let's get to Rebecca Felton. She's Senior Market Strategist. She's over at Riverfront Investment Group. She's joining us here on this Tuesday. Rebecca, first of all, I do wonder how much crypto and the crypto world, and we use that term very broadly because it covers a lot, how much of that occupies the space over at Riverfront?
Well, thank you so much for having me this afternoon, and really very little because we are a traditional asset manager and our client base is fairly conservative. But what we need to know is, of course, what's going on with those entities and what exposures some of the financials that are traditionally in portfolios, what exposures they may have to them. So that's how we keep up with it. And that's maybe some of the relevance in terms of our conversation here at Riverfront.
Well, let's talk a little bit about that and how you're thinking about asset allocation coming into 2023 and opportunities that you're seeing for your clients at Riverfront.
Well, Romaine, we're kind of stuck in neutral a little bit. Because we have gone to neutral levels of stocks recently, as well as bonds, because we're finding them more attractive as it relates to the yields. But our tactical signals are telling us to remain somewhat cautious. You know, the Fed is still working against us. The 200-day moving average is still falling, and investor sentiment is negative, but it's not negative enough to warrant us to put more money to work. So we're neutral stocks, neutral bonds, neutral cash, and just waiting, I guess, for some clarity around what the inflation picture may look like as we get into the first of the year, and what is still likely to happen with earnings revisions. You know, we've seen earnings trend lower, and there's still some risk that could continue.
When you look at some of the consensus estimates out there for earnings, at least in aggregate on the S&P 500, you think those numbers are still too high?
They very well could be. Obviously, the inflation picture and cost pressures for some of these companies could impact margins. So that's something that we're going to be paying very close attention to. You know, we're getting ready just in a few weeks to start navigating through Q4 and full year earnings reporting season. So there will be a lot to learn there. And we do believe that there is some risk to earnings to the downside.
All right. So, Rebecca, with just a few days left here in 2022, you've got the NASDAQ 100 down about 33%. You've got the S&P 500 just down about 19%, just 9. I say that with quotation marks. Technology really beaten up this year. Is that a play for you, though, when you do eventually feel more confident about the market outlook?
Well, depending on the strategy and the time horizon, we are neutral to slightly overweight technology, not significant. We're focused there on software and services because we do like those recurring revenue streams. We do like the cash flow there, and so we're still leaning.
There's a lot in the software space.
Slightly.
Anybody in particular?
We're more broad. We're not going to talk about individual stocks today. Sorry, I can't do that.
But it does raise a question about the way that software stocks have been beat up, especially some of those growth stocks that have IPO'd in recent years, cybersecurity stocks, software service stocks, cloud stocks, as well as Carol mentioned. Can you narrow it down any more?
We're thinking large blue chip type names, some of the biggest names in the index. That's where we think that there is still relevance for our clients.
Just final question here, Rebecca, and this really has to do with the liquidity, whether we're talking in fixed income or even in the equity space here. There's been a lot of concern here that liquidity is low, or at least lower than where a lot of folks think it should be. And the absence of the Fed as a player, I guess, and this primarily, I guess, reflects more its influence on the fixed income market. But without them there, do you think that we could see a return to those liquidity conditions that we had prior to this year, or do we have to sort of get, I guess, adjusted to a new normal?
It might be a mixture of both. You know, again, we don't quite know what the Fed, what their normal level of balance sheet runoff is going to end up being. And we haven't really experienced a lot of issues there yet. So we have not been overly concerned about it yet. Certainly something to watch.
All right. Thank you so much for joining us this afternoon. Rebecca Felton, Senior Market Strategist at Riverfront Investment Group. Really appreciate you taking the time. Now, keeping you up to date with news from around the world, here's First Word with Mark Crumpton.
Tim, thank you. Japan will now require negative COVID-19 test results for travelers coming from China. Prime Minister Fumio Kishida told reporters that the policy will take effect from December 30th. Those who have been in mainland China within a 7-day period will be required to undergo testing upon arrival. The change comes as China throws open its borders and abandons its COVID-0 guidance. Vladimir Putin is striking back over the price cap imposed on Russian oil. According to a decree, President Putin has banned the export of oil and oil products to foreign buyers that adhere to the cap. The group of 7 industrialized nations imposed the $60 per barrel limit to punish Russia for invading Ukraine. Power grids in Western Europe will get a break going into the new year. Warmer temperatures will reduce the strain on energy systems, which were stressed earlier this month by the first cold snap of the winter. Forecasts call for high temperatures of 16 degrees Celsius in Frankfurt. That's more than 10 degrees higher than the 30-year average on New Year's Eve. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much for that update, Mark Crumpton. Really do appreciate it. Tesla right now trading at its lowest level since 2020. It's down close to 10%, down for 7 days in a row. A lot of headwinds facing the company. We'll talk about what 2023 has in store. You're listening and watching Bloomberg Markets, The Close. This is Bloomberg.
How much much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Well, to say it's been a wild year for financial markets might be one of the understatements of, well, I don't know, the decade. As we sort of wrap up 2022 and look ahead to 2023, a lot of people really want to know about the big themes that investors are going to be watching. Abigail Doolittle joining us right now to walk us through that a little bit more. And Abigail, is there any hope out there for 2023?
You know, it's interesting, Romaine. There may be some hope, and interestingly, it's in the domain of what you often think of me as, you know, the technicals. It's interesting, just 2 months ago, the technicals looked like it was going to be an awful 2023, but now it appears as though we could be a little bit sideways. But when we think about 2022, I mean, stocks absolutely hammered, the worst year since 2008, but it's not just stocks, it's bonds also. Bonds had their worst year since 1999, you know, so where to turn to? One thing that I would point out, typically you don't have two big down years in a row for stocks, but the exception is 2000, 2003. All year long, this year has reminded me of that time period. Another similarity, there was never really a recession there. It was a valuation recession. More similarities coming out of the pandemic.
And let's be real. I mean, historical narratives almost don't really apply to this year. I mean, what we're in right now is just so much different than anything we've had in generations.
Because you don't remember coming out of a pandemic before?
I haven't, not me.
To be serious, right? Like, how do we figure out what really matters?
It's interesting. It is definitely a fair point because of the pandemic. I would say more than thinking about the pandemic, it's the liquidity. So what's so different, but at the same time, the same is the liquidity. We've been in this incredible liquidity situation for more than a decade. Now the liquidity is coming out. So now we're going back to trading that's more like pre-2008. A lot of people out there trading don't quite remember another similarity to 2000, 2003, which may suggest maybe we are going to see 2 down years in a row.
Abigail, we sometimes laugh. We did at the top of the show, right, when we talked about the Dow and outperforming. We've seen that a few times this year. How do you think about Dow outperformance, and how does the street think about it?
I'm so glad you're asking, because I think it's a pretty important point that
that wasn't planned. It just happened.
It's not a part of our pre-planned question. You know, the street, I think, is overlooking it, but when you take a look at the Dow above its 200-day moving average, at one point above its August high, the DAX is also in a similar situation. The NASDAQ Golden Dragon Index, those China stocks, on the idea that you're going to see China reopen. I don't think that you can rule it out because the Dow is more narrow, and because of that, more concentrated. Sometimes it can lead, even though people like to count out the Dow.
I want to talk a little about energy because 2022 was a wild year, at least when it came to energy prices. A lot of that tipped off by Russia's invasion of Ukraine, of course. We have seen a pullback when it comes to energy prices, at least over the last few weeks. what does 2023 have in store when it comes to energy markets?
You know, that's a really great question, Tim, because oil on the year, like Romaine was talking about, wild does not even begin to describe it. There's so many factors that are beyond anybody's control. One thing that's so interesting about energy is this year it's up 60%, last year it was up 50%, and it's the only sector that investors can agree to hide in. So I think it's going to actually have to do with other sectors. If other sectors are scary, then energy, the sector itself, maybe climbs irrespective of what happens with oil. Otherwise, maybe you're going to see it be like one of those Dow of the dog or dogs of the Dow type of thing where, you know, the best sector one year is the worst next year.
Well, you mentioned hiding out. I mean, obviously we know the best performers, at least in the S&P, are all pretty much all energy stocks on a top 10 basis. Normally the place to hide out, if you wanted to stay in equities, you would sort of look to Apple, some of the big cap tech names, at least the ones that had more reasonable valuations. That really hasn't been the case this year. I mean, Apple's down almost 30% on a year-to-date basis.
Yeah, it's pretty incredible. I mean, this is a true year of what goes up must come down. You had these huge, huge gains out of the pandemic. I think you really have to keep that in mind, that these stocks outperformed in such a massive way for a couple of years. So now Apple, there are demand issues, there are supply issues around the iPhone. Valuation isn't necessarily cheap. Right now, it's holding very important support. It'll be interesting to see whether or not that can continue. Speaking of, Tesla is sort of a similar situation, holding
I was going to say to you, I'll take that 26% year-to-date decline in Apple and give you down almost 70% year-to-date in Tesla.
It's incredible. Like, who knew that this was possible? Because that was another stock that you would hang out in times of liquidity being pumped into the system. I mean, CEO Elon Musk is often criticizing the Fed, and this may be a piece of it, that all of that liquidity helped out a high-growth stock. Now, that said, I think that this stock is close to being attractive for people to buy, not just from a technical standpoint, but valuation. The PE may be 34 times, but when you think about it, the other metrics that auto companies are valued on, like debt to equity, inventory turns, ROE, it's actually pretty attractive. So at some point, you could see this, and it's the most oversold ever.
Elon Musk would say, we're not an auto company.
Well, you have the auto, and so on a tech basis, 34 times is actually probably cheap relative. Although that said, Apple's at 20 times, and that's expensive relative to Apple. So it's
sorry, we're still doing this is a tech company, not a company thing.
Those are
Abigail Doolittle, folks. Thank you very much.
All right, Abigail, thank you so much. We're going to stick with Tesla, folks. As we said, down 10% at its lows in today's session, down almost 70% year to date. So let's get to our Esha Day, covers Tesla for us here at Bloomberg. Yeah, well, Esha, how should we? It's so funny that you say that. How do we think about Tesla? Tech company, car company, what?
Hi, and thanks for having me.
Yeah.
I don't think that debate that we always had about Tesla, whether it's a tech company, whether it's a car company, or is it a weird amalgamation of tech and a car company, that has not been settled yet, really, right? Because on one hand, if you compare Tesla with Tesla has declined this year with the other technology mega caps. It's the worst performer on the NYSE Fang Plus Index this year. It's worse. It's doing even worse than Meta Platforms, which is Facebook owner, and about whose troubles we are all pretty familiar with. But I think it also comes back to this argument that what is common, however, especially in this big sell-off this year, is that for most of these companies, that aggressive growth outlook that was built into their valuation at the beginning of the year has started faltering, and that's exactly what we're seeing.
Well, let's talk a little bit about that, because I mean, we know the underperformance versus some of the tech companies, even underperforming traditional car companies like Ford and GM. But there was that growth story that you mentioned here, and there's been so much chatter over the last few months about some of its production levels, particularly in China, some of the demand levels, the competition out there. Is this sort of that reckoning, the idea that for years, Tesla was the only game in town, the only game in the world for the most part, if you wanted to buy an electric vehicle, and that's not necessarily the case here in 2022, and certainly not going to be the case over the next 2 to 5 years?
Right, and that's a great question. Reckoning is a word that I'm hearing a lot from my sources this year, both bulls and bears on Tesla, right? So it's definitely a reckoning for the bulls who kind of knew that Tesla is a stock that was priced for perfection, and the picture of perfection is definitely seeing some cracks, more than cracks, right? Especially the news that we had over the long weekend about the temporary halt in the Shanghai production plans, And that is kind of combining with another news that we had last week that Tesla was offering this actually pretty hefty and pretty rare discount on its cars in the U.S. So that consumers take delivery of Model 3s and Model Y cars before the year end. All of this taken together is really fueling concerns that demand is or may be faltering for EVs, which are actually more expensive than typical gas-driven cars.
Esha, I'm wondering about the Elon Musk factor here. I'm looking at a recent note from Dan Ives. He's got a $175 price target over the next 12 months on the company's stock. He is, of course, from Wedbush. He's bullish on it. He said, need a leader at this time for Tesla, not a Ted Stryker. At the same time that Tesla is cutting prices and inventory to build globally in the face of a likely global recession, Musk is viewed as, quote, asleep at the wheel from a leadership perspective for Tesla at a time that investors need a CEO to navigate this Category 5 storm. So what could Elon Musk do, according to analysts you've spoken to kind of fix this, at least, image that he is asleep at the wheel?
It's, again, great question. And what Tesla is really, as we said, like what Tesla investors are really reckoning with right now is this kind of, this was always a double-edged sword, right? Elon Musk is a genius who can alone kind of justify the kind of valuations that Tesla had.
Yeah, but that genius narrative, a lot of holes got poked into that primarily, well, really even before Twitter, but once, of course, we saw how Twitter went down and the purchase of that and some of the emails. I think there was a little bit, of a reassessment, I guess, of what his contributions actually were to the success of some of these companies.
Definitely. I guess, the myth of genius actually did better when there wasn't so much transparency into how this genius works, right? But when that starts happening in full daylight, when he's running Twitter on Twitter, and kind of people are getting this idea of blow by blow of how he takes decisions, maybe some of that confidence in his ability to be able to take Tesla and drive Tesla through this impending recession that we are going to see possibly in 2023, that faith is now getting shaken quite a bit.
All right, we're going to have to leave it there. I mean, we talk here about the idea of Tesla being one of the worst decliners here on this particular day, but of course, also one of the worst performers on a year-to-date basis as well for a company that had an amazing growth story and probably still does.
Analysts still really bullish. Highest share of buy or equivalent rating since early 2015, so go figure. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
A tepid open for U.S. equities on this Tuesday morning, and now on this Tuesday afternoon, a relatively tepid close here. Stocks right around the lows of the day, pretty much across the board. The one bright spot on the day remains the Dow Jones Industrial Average, finishing in the green, but only by about 0.1%, 33.24 and change right now. Again, not far off the lows of the day. The S&P 500 down about 0.4%. The Nasdaq closing down by 1.4%, while the Russell 2000 also moving lower here on this day, down by about 0.6%. The bright spots today: energy, guys; utilities, guys; consumer staples, guys. That's not the type of leadership that you want to see in this market, but frankly, that's been the leadership that we've had for a good portion of the year. Consumer discretionary names, the communication services companies, technology names, and Tesla, which, depending on what you believe, Carol, whether that's a car company or a tech company, nevertheless, it dragged this market lower big time, down 10% on the day.
All right, well, trying to push the market higher overall were certainly those Chinese names that trade here in the United States. Once again, the big story, it's among the most read. It's something we've been talking about a lot over the last couple of hours, has to do with China rolling back the last of its COVID curbs, and that has been reflected if you look at the names, the Chinese names that trade here in the United States. We're talking about the ADRs. So that index is up more than 50% this year. It's up another 2% in today's trade. So we continue to see, actually up 53% since late October. So it's just recently in the last couple of months that we've really seen these names on fire. And again, adding another 2% today. As a result, we're also looking at the gaming companies today, because as China reopens, Macau opens, we look at those gaming companies here in the United States with a lot of Macau exposure. Wynn is among them. So is Las Vegas Sands. So Wynn, it is up about 4.5% here at the close today. This was top of the S&P 500. We looked at gold too. We were watching the commodity space overall. We saw Barrick Gold. It was up about 2.2% in today's session. And then Booking Holdings. This was a name that was top of the NASDAQ 100. We're going to talk about this in terms of what, folks are doing right now. They're not buying as much stuff, but man, they are traveling despite, we know, the weather complications over the last week or so. Those planes are packed, airports are packed, and Booking Holdings, top of the NASDAQ 100. It's up more than 20% since mid-October.
And I want to add one gainer there, and it's JM Smucker, only up about 0.3%, but closing out at a record high on the day. In fact, if you do a chart of that just over the last 6 months, it's probably one of the best looking charts you're going to find out there. Unfortunately, I'm not sure that's really indicative of a bullish market, but at least for them, definitely good. It's up like 30% off those June lows.
All right, speaking of something not bullish, investors on Tesla over the last few months, weeks, well, look at this, down 11.4% today. Shares down another $14, closing at $109.10. Lowest since August of 2020, the most in a single day as far as declines go since April 26th of this year. Investors concerned once again about demand issues out of China. This one after a report of a plan to completely temporarily halt production at a factory outside of Shanghai. Southwest Airlines shedding 5.96% today. We can go ahead and round that up to 6%, its biggest one-day drop since July 28th. The company, of course, continuing to try to weather the storm that continues to make its way, and we see the tail end and the remnants of that across the eastern United States right now. Southwest canceling 2/3 of its flights today. The company coming out with a statement saying, quote, with consecutive days of extreme winter weather across our network behind us, continuing challenges are impacting our customers and employees in a significant way that is unacceptable. The company could see a hit of up to 3.2 to 3 to 5% of its revenue for this quarter just because of that storm. AMC Entertainment finishing the day down by 8.4%. Continuing after last week's slump, it fell 7.4% on Thursday, 10% on Friday after proposing to convert preferred equity units into common shares along with a 10-to-1 reverse stock split.
Oh.
You were on vacation.
That's an interesting strategy.
It is.
Okay.
Well, the company's CEO, Adam Aron, said he didn't want Wall Street to punish it into a penny stock in penny stock territory.
Yeah.
Investors certainly have been punishing it since then. Did you
know
see
how
the
you
news
can avoid
today?
that?
How?
Revenue growth, profitability.
I mean, the
what fundamentally changes?
I'm old.
Fundamentals
I know
with
it's a
the
whole new
meme
world
stock,
out there.
Romaine?
I know. Well, we should point out all the other meme stocks are moving lower too. GameStop down 10% here on the day, and I was actually looking at one of the main indexes that tracks a lot of the SPACs, and that's just absolutely brutal today. WeWork was down, I think, something down like 15% here on the day. Real quickly, though, I do want to just walk you through what we did see in yields today, because that was where a lot of the activity was in the Treasury space. Very persistent selling pretty much across the curve. That actually pushed the 2-year yield up by about 7 basis points. A lot of activity in the belly of the curve, 9 to 10 basis points on your 5, your 10, as well as the 20-year, 11 basis points on the 30-year. That's the setup here on the day, and I guess that's going to be the setup potentially going into 2023. Pleased to say, joining us right now to walk us all through this is Jeffrey Crumpleman, and he's the Chief Investment Strategist over at Mariner Wealth Advisors. And Jeff, it's been an absolutely brutal year, whether you're talking just in terms of price performance, whether you're talking in terms of volatility. Do you anticipate that 2023 is going to be any better?
I do.
Okay, why?
So, well, I think that the big thing here is that the economy and earnings and the stock market are two different things. One is a snapshot in time, and because of the lag in data flow that comes out, it's actually rear view mirror in nature.
Right.
The stock market acts in advance. And so I think one of the bearish arguments are that the next shoe to drop is we're going to have earnings that are going to be revised negatively. And quite frankly, I could show you a number of years where earnings are negative and the stock market actually does very well.
Right.
This year is the inverse.
Is that going to be sort of a look ahead? Like you're basically saying people are looking ahead to 2024
That's
and beyond,
exactly
rather
what
than
it is.
2023. Okay, gotcha.
Exactly.
Yeah.
So this year's the inverse of that, right? We had good earnings.
Yeah.
And the market was horrible, as you say.
Yeah.
So to us, what we see is, Rocky Balboa used to say, it ain't so bad, or you ain't so bad.
Yeah.
And we see that in the economy.
That was to the guy who just punched him in the face. He would usually say that too, right?
Yeah, he's right. yeah, exactly. So, but he took the punch.
Yeah.
He took the punch and he moved forward, right?
Yeah.
And I think
Not so bad for Rocky.
Well, he didn't look so good sometimes, but he was able to succeed. And that's the point here, that we're going to work through it in 23.
Let's talk about, I'm so glad that, Romaine, you talked about what happened in the Treasury trade today, because I do wonder about stocks and bonds being in sync in terms of the pricing. And so we both saw stocks and bonds go down today. And I was looking at a story, U.S. bond funds seeing the biggest weekly outflow this year has come from Barclays. I mean, investors are turning away from the Treasury trade. What do you make, first of all, of bonds and stocks trading in sync and then investors moving out? Are they anticipating, again, that things get better?
Well, I'll tell you what I think about the bond market's interpretation so far of what's going on. And it actually gives me confidence in the direction of the equity markets.
That they have it right, that the Treasury trade, or what?
That the bond market, actually, we haven't seen the vigilantes come out. And you can talk about what's happened over the last week or the last couple of days, but quite frankly, the 10-year is below 4%. And the problem in the 70s was...
3.84 today, yeah.
There you go. Back in the 70s, when you really had an inflationary problem that was truly not transitory, truly permanent in nature, you saw the bond market sell off in a huge way. Bond market's not saying that, man. The bond market's saying maybe not a recession's on its way. Maybe the Fed's got it wrong, and we think they're going to blink and they're going to start pausing, and we're not going to have inflation. Guess what? It's calming. Maybe they see the fact that CPI right now, or PCE, is running at an annualized rate of 3.5%. not 8, not 9, not the stuff that...
But how do you reconcile that with the gap that we're seeing between the projections that the Fed put out? And obviously this applies more to the 2-year rather than the 10-year. But even that's at something like 4.4, and you have a Fed that's targeting something like 5.1 as a terminal rate. Does that gap need to close?
Well, I think that we also would agree that we're probably going to 5 or 5.25.
So the gap closes
But you know
out,
what the average
right?
Fed funds rate is over time?
No, what is it?
5. So we're back to average, guys.
Yeah.
And it's so funny how, I think
So
that...
no one under the age of 30 knows that.
Well, it's a good thing that I do, because maybe...
Not saying you're over 30.
Right?
You look great for
Yeah,
your age.
I'm like double that and then some. But that's the point. I think, we need to chill. We need to just take a breath here. And, if you stop and smell the coffee, things are not very bad. In fact, I would argue, not too long ago, we were talking about the new normal, like it was a horrible thing. Well, you know what? We're going back to the old normal. How about that? And the old normal is like 2% GDP growth, and inflation is probably 3 to 4. And anyone that thinks inflation's going to 2%, do you guys really think that in a period where we are going to see globalization kind of cease, free trade
But
not
Jeff,
be what it was, re-onshoring?
what do you make of the structural and fundamental changes? We talk about that, right? The pushback against globalization, supply chains. We talk to the CEOs, we all do, about them doing much more onshoring or nearshoring. Like, they're rethinking. And also, energy markets in a transition.
Yeah.
That means you're not going to have the big integrated oil companies pumping a lot of money as investment dollars into amping up what they're doing, because other forms of energy are potentially coming. Maybe. I mean, at least that's part of the argument. What about those fundamental structural changes?
I think it creates opportunity for folks like myself. What do you want to own? How do you want to be positioned? And you know what? The day of S&P 500 index investing, if I got $1 for every time I heard, the folks that do what I do, you're an antique, and your day is past. This year we've outperformed handsomely. And I'll tell you why, because stock picking matters. And you know when it matters?
What was outperformance? Less of a decline, or what was outperformance for you guys?
Well, okay. It's hard to get up and go, hey, Mom, guess what? Your son did really well. We went down 7 and the market's down 17. But that's what you're paid to do. Now, when this starts to move to the upside and you have balance sheets that matter and business models that matter once again, then you can say maybe, hey, Mom, I'm up 15 and the market's up 13. I don't know. That remains to be seen. But we did it by focusing on high quality and by actually being very diversified. And whether it was in industrials or it was in consumer discretionary, bookings is an example of something that has an added value but should on the upside. It matters what you own. And revenue does matter. Earnings growth does matter. And we happen to own some companies that held up with strong balance sheets and good earnings profiles.
All right, Jeff, great to catch up with you. Jeff Crumpelman there, Chief Investment Strategist over at Mariner Wealth Advisors. We do have some breaking news crossing the Bloomberg terminal right now. This involves the immigration restrictions here in the U.S., specifically what's referred to as Title 42. These are the border restrictions that were effectively put in place because of the pandemic. There had been efforts in Congress to relax those restrictions and efforts by the Biden administration to do so. The GOP, the Republican Party, challenged that. We're now learning that the Supreme Court has ordered Title 42 border restrictions to be kept in effect as a way the GOP's requests to actually extend them. So once again, one of the key immigration issues here in the U.S., a big political football, we should point out, now in the hands of the Supreme Court, at least for now, as they try to figure out what to do. And of course, guys, this actually feeds into a lot of other things, including our labor situation, something that Jay Powell himself has also addressed.
Right. We've heard from a lot of individuals, including CEOs, saying the importance of opening up the borders because we have such a tight labor force.
All right, we'll keep an eye on that and bring you any additional details on that. In the meantime, we do want to get over to Mark Crumpton and the Bloomberg First Word News.
Romaine, thank you. The fraud case against FTX co-founder Sam Bankman-Fried has been reassigned to U.S. District Judge Lewis Kaplan. The switch comes after the original judge recused herself over a potential conflict of interest. U.S. District Judge Ronnie Adams stepped down from the case because her husband is a partner at law firm Davis, Polk & Wardwell. She said the firm is currently representing parties that may be adverse to the proceeding. In Michigan, the co-leader of a plot to kidnap Governor Gretchen Whitmer before the 2020 election to 16 years in prison. Adam Fox could have gotten a life sentence. FBI informants helped law enforcement break up the plot before it could be carried out. Fox's lawyer says he was manipulated by the informants. Taiwan is sending a signal to the U.S. and China that it's serious about defending itself. President Tsai Ing-wen is extending compulsory military service for men from 4 months to 1 year. Taiwan has been working with the U.S. to strengthen its defenses against a potential Chinese invasion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much for that update, Mark. Really do appreciate it. Well, the U.S. housing market continued to sag in October. Higher mortgages, rates, concerns over the economy, rattling buyers and sellers. We dive into that right after this. This is Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
All right, everybody, welcome back to Bloomberg Markets. Carol Massar along with Romaine Bostick and Tim Stanovic live on radio, TV, YouTube, and on Bloomberg Quick Take. And we want to talk a little bit about the U.S. housing market because continuing to soften, we see the impact of those higher mortgage rates, and it continues to put pressure and really make it tough for both buyers and sellers. We got some data points today. So let's get to it with Pierre Debas. He is co-founder and managing partner at Romer Debas, and they are a boutique real estate investment firm. So they are working with buyers and sellers. Pierre, so timely to have you here on this Tuesday. Real estate market, you deal with commercial, you deal with residential. How would you describe it right now?
You know, Carol, it's great to see you and happy holidays.
Yeah.
At the moment, the best way to describe the market, both on the residential and commercial front, is a pure point of stagnation. Interest rates clearly have almost tripled in less than a calendar year, which you can imagine, you know, real estate is one of the segments of the economy that's most interest rate sensitive. And for the time being, you know, it takes roughly a 6-month cycle for valuations to adjust to factor in economic factors like the rapid rise in interest rates. And during that time period, and potentially even longer, given how drastic this has been, everybody's going to sit on the sidelines, both sellers and buyers. And we're seeing that across the board. The last 2 quarters have been beyond indicative of that. Right. And I anticipate at least the first 2 quarters of 2023 will demonstrate that as well.
Even with the traditional spring selling season, you think that that's going to still be impacted, even though we have seen mortgage rates moderate a little bit, even though we have seen prices, for that matter, moderate as well?
You know, Romaine, I'm hopeful that the spring season, you know, kind of counteracts a lot of the negative impacts of what's happened. I'll be honest with you. One of my biggest predictions is that we're going to have a low single-digit decline in pricing over the next year. And actually, Fannie Mae's economist came out with a prediction of 1.5% in the housing market decline next year and 1.4 in 2024. So when you factor in things like inflation increasing the average cost of living by $500 to $1,000 per household, interest rates almost tripling, the impact on your inability to save money to put down, the uncertainty of the labor markets, this poses a huge problem for demand and activity in the housing market. Now, the reason pricing won't come down, because what you're alluding to is why wouldn't pricing adjust even more? The reason being is that we have just a tremendous shortage of supply. And at the end of the day, even with the reduction in demand and all the factors I'm describing, we're seeing, we're confident that pricing will still be fairly stable.
Is New York, though, a unique market? I mean, you've already seen some double-digit declines in other parts of the country, in the Sun Belt and parts of the American West, for example.
For sure, Tim. New York's a bubble, right? Like, for instance, I'm a real estate lawyer, and we have a mid-sized law firm in Midtown Manhattan that specializes in real estate transactions, with our primary niche being in New York City. And the great thing about that is that New York City oftentimes is insulated from, the turmoils of the economy, just due to the high level of affluency. But even with all that, I'm seeing transaction volume down 35% from where it was at the beginning of the year. And that's a terrible reduction in encounter in a short period of time. And again, when will that, uptick back to more normal levels? No one knows.
Hey, Pierre, so, there was a lot of discussion, certainly by all of us here at Bloomberg, about what lasting impact the pandemic would have on commercial real estate in particular, whether it's retail, whether it's office buildings. What is sticking, what is not?
I'll tell you now, what I'm seeing is small box retail is doing exceptionally well, specifically in New York City, because it's a good opportunity for small businesses to come about, lock in space at a favorable term, favorable rates, and to, the city is vibrant as could be, right? The workforce isn't back. Only 50% of the workforce is in, but the city itself is vibrant where people are out 7 days a week. Now, larger box retail was in a precarious position pre-pandemic. I think that this only compounds that problem. What we are, the biggest issue that we're going to encounter in the commercial real estate market is the future of office space. The future of office is still completely undetermined. Even now, I keep telling everybody we're in year 3 of this, right? Like, part of this is a new normal.
Right.
And when you're in year 3, we don't have half of people working from home because they're worried about virus anymore. It's just a way of life for many people. And companies have adapted and downsized and taken advantage of the opportunity. Others have doubled down and taken on more space, realizing that, you can only build a business in reality by, collaboration and being together in person.
Pierre DeBoss, always great to check in with you and chat real estate here in New York City. Pierre DeBoss is co-founder and managing partner at Romer DeBoss. Well, let's talk travel, because the CEO of the hotel chain Accor says he's expecting the rebound in tourism demand. Here's some of that conversation.
We're pretty convinced it's going to be carrying at least for the first quarter of 2023. First semester, I don't know. 2024, I have no idea. No, seriously, with what's happening in the world, with inflation, with maybe recession, thank God we had a good 2022. I think we're going to have a good first semester 2023. And then the odds are, I don't know. But I'm a true optimist, so it was better recovery than we expected, stronger demand. And so it should be carrying on as long as people have the wherewithal to travel and money to spend on leisure.
You've made some big bets on China, as have many others in the industry. You've seen the images over the weekend coming through in terms of the protests, zero COVID policies. Yeah. How does that weigh on your outlook for the new year? I mean, does that change anything for you at the moment? What are you hearing?
No, it's too late to change anything anyhow. So I guess you just have to make a long-term bet on China. We've been in China for 45 years. So another year and a half of hiccup, I can cope with this. So, we need the Chinese travelers to come back outside of China, but we haven't seen them for the last 3 years. So we probably won't see them until summer at best. Good news is the Chinese hospitality market is today in the hands of 93% Chinese customers, and it works. It actually works better than I expected myself. So I need the Chinese outside of China, but I'm probably okay with Chinese remaining closed for the international travelers.
So what kind of deals might you be looking at here? I mean, in terms of
I'm trying
the
to
expansion into the kingdom?
I'm trying to convince everybody that we have to shift the mindset from targeting to traveler to target to local. So I want the Accor hotels tomorrow to be really designed for the local community, because if you seduce a Saudi in Saudi Arabia, the travelers will pick and choose your hotel because it's a buzzing destination. So just reshifting our own mindset. But here, I'm going to go from mid-scale to premium to resort. We are all over. I need to be stronger.
I'm going to drag you to rainy and cold Europe for a moment, just to get your view on the room rates that keep pushing higher. Is that sustainable, in light of the impact of a recession that is still very much rippling through the economy?
Well, I think France is going to be avoiding recession. I'm not an economist, but I guess we're so much of a subsidized country. When it goes very well, we don't go very well. When it goes very bad, we don't go very bad. So France should be out of recession. UK, unfortunately, might be. It's one of those things where we've been coping with minus 80% occupancy for 2.5 years. Every time there's a recession in the world, -3, -4, RevPAR goes almost to the same indexes, which is -3, -4. I can tell you, we can cope super well with a -3% activity when you've been going through -80%. So I don't wish for it, but we will adapt for it in a much better manner than we ever did in 2008, 2009.
You're going through a reorganization internally. I'm wondering to what extent there's room for further job cuts as part of that reorganization, given the reality that you're seeing in the economy, no?
Youssef, I'm missing 40,000 people within my 280,000 people organization. So don't even think about a job cut. I need people back at Accor. That reorganization is only trying to have better expertise, more focus in the right segment. So we're splitting Accor in 2 autonomous divisions, Eco, mid-scale, premium, and 1 on luxury lifestyle. It happens to be different segment, different owners, different clients. And I was dumb not to have done it earlier. Probably did not do it because I didn't have the skill, ability to do it, but it's indispensable, and it's live on the 1st of January. And sense of ownership from my executive team is far better than I ever expected myself. It's going to work extremely well, but it will not be at any job expense.
That was Accor CEO Sébastien Bazin in an interview just last month. Remarkable to hear him talk about those demand figures. But look, this week notwithstanding, last week notwithstanding, when it comes to airlines and what we've seen from airlines, we heard the same thing earlier this month from the CEO of Delta. People are out there spending their money.
That's remarkable about the lack of workers that he's still looking for.
Yeah, it'll be interesting to see, though, whether that continues. I mean, we talk about some consumers being tapped out, but also the idea, too, that just the cost basis, too. Yeah. I mean, part of the reason why we had so much revenge travel, I think, in 2020 and 2021 was because, well, you can get a ticket dirt cheap. You can get a hotel dirt cheap. You can't do that anymore.
Right.
Yeah, those days are gone. Well, what does 2023 have in store for companies looking to focus on growth? We talk about that right after this.
consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
All right, welcome back to Bloomberg Markets. The close. Romain Bostic here alongside Carol Massar and Tim Stinovich. We talk about what's happened here in 2022, and more importantly, we're looking ahead to, I guess, what could potentially happen in 2023. Scarlet Fu put together a nice little package looking back at the year that was. Or maybe, or no, who knows? All right, well, we'll get to that in just a second here. Let's bring in Bloomberg cross-asset reporter Emily Grafeo into this conversation now to talk a little bit more, I guess, about what we've been seeing in the market. And Emily, I mean, this has been a crazy year. We know that. There have been a lot of people that are looking ahead to 2023, and they say, maybe you get some right sizing, maybe you get that mean reversion, maybe you get a new normal. What are we expecting?
Well, yeah, it's interesting when you look at all of the outlooks for 2023. Certainly a phrase that I've seen on a lot of outlooks has been bonds are back. There are a number of big asset managers and also sell-side strategists saying that this is the year to get back in fixed income. Buy the dip now. It's been a tough year. I think one of the worst years on record for the Bloomberg Ag, but that's definitely a trade. And then in terms of the S&P 500, the consensus expectation is for a little bit more downside in the beginning of 2023, and then for perhaps a rally for the second half of the year.
Okay, what do we mean by a little bit of downside? Are we talking, 3,500 here, or are we talking even below that?
One of the lowest estimates was for 3,000 in the S&P 500, which would be a pretty big dip, but there is a fair bit of uncertainty as to whether we're going to get it 3,000. There are some strategists saying we're going to go all the way back up to 4,400. I think that speaks to the uncertainty right now and the difficulty with positioning as we head into the beginning of next year.
All the way back to 4,400, which we've already been to 4,400. That's not really a gain. I mean, I guess if you buy it today, I guess if your cost basis is today.
Just going back home
great.
again,
Okay.
right?
All right, just pointing that out.
It's all going to depend on valuations, market outlook. There's so much coming on. Earnings season. Do you think that that could potentially change things dramatically in terms of how we think about valuations?
Yeah, I mean, when we look at earnings, the consensus expectation for next year is for the earnings to continue to come down, and yet you're still seeing some inflows into ETFs that track technology stocks. There does seem to be a little bit still of investor interest in these areas that some may argue are still too highly valued given where rates are.
I mean, so can you get even more particular than that? I mean, I know that you're not making calls here, but what are your sources telling you? Because Carol made an interesting point about Tesla, for example, down 69% so far this year, but analysts are incredibly bullish on it.
And there is, if you look at its RSI on the technical level.
Relative Strength Index.
Yes, Relative Strength Index. It's at one of its most oversold in history. So there is an argument to be made that there could just be a dip to be bought on the technicals alone.
Right, but that's a hard case to make with Tesla. I mean, we're talking about a valuation that I think even the most bullish of people would say was probably stretched at a certain extent, definitely this year and in years past. And the idea that no matter how you value this company, whether you're valuing it as a tech company or as a car company, we kind of joke about this, but there is a distinction here. But even at either valuation, some people would say current valuations are still too high.
Oh, yeah, absolutely. I get a lot of sources who say earnings have to come down even further, but there still seems to be a hesitation on just how much.
Well, and you know what's interesting? You look at something like RSI, it's been oversold. It rallied a little bit, but then went back down. So we continue to see a lot of pressure, certainly, on this name. All right, Emily, we're going to run? Obviously, we're
They still got to produce cars, though, right?
Well, yeah, but you know, I think what's very different is fundamentally they've got a lot more competition, you know, especially in that luxury space.
I think that's going to be, I mean, we don't know all the details, but particularly when it comes to China, you hear so much about just the options that buyers have that they didn't have 3 or 4 years ago.
Right. I mean, we're not talking Volkswagen, Ford, you know, Mercedes, BMW, like we have here in the U.S. and in Europe, right? We're talking hundreds of competitors in China, literally
we can keep talking about this. I do think that we have a package that we want to run. I tried to toss to a little bit earlier. I'm told they've cheated up now. It's kind of like reel to reel. So roll that beautiful bean footage. Let's hear it.
So 2022 was quite the year. Here's Bloomberg's 2-minute roundup. In January, the Federal Reserve laid the groundwork to raise rates to tackle the fastest inflation in a generation. Adding to global inflationary pressures, Russia's invasion of Ukraine. The attack began in late February and dominated headlines, from the destruction on the ground to U.S. sanctions on Russian banks and oligarchs. By March, attention zeroed in on the specific threats that Russia posed, restricting the flow of natural gas to Europe and attacks near a nuclear power plant in Ukraine. Corporate drama started to pick up in April when Elon Musk made a $43 billion offer to take Twitter private, while Netflix reported a loss in subscribers and changed its strategy to embrace advertising. The theme in May, market mayhem, as the Fed boosted the size of its rate hike to 0.5 percentage point, sending U.S. stocks to 13-month lows, while a single trader at Citigroup made a mistake that sparked a flash crash in European stocks. Recession fears took root in June. Half the headlines of Bloomberg's 10 most read stories that month featured the R word. Another R word, Roe, after the Supreme Court overturned Roe v. Wade. Geopolitics were the big stories over the summer. The killing of former Japanese Prime Minister Shinzo Abe, and Nancy Pelosi defying China when she visited Taiwan. The UK lost its longest-serving monarch in September. 2 weeks later, the new Prime Minister unveiled unfunded tax cuts that caused the pound to crash. In October, Credit Suisse became a meme stock, setting new lows as some retail investors bet the bank would go bust. While Xi Jinping consolidated his power, adding more loyalists to China's leadership. Crypto winter arrived in November when FTX collapsed, destabilizing the industry. And by December, bankers were tallying up the costs from slumping markets, sparked by the Fed's rate hike campaign. Their wallets will take a hit as Wall Street firms prepare to slash year-end bonuses.
A big thank you to Scarlett Fu for that year in review. For more quick take, check out Bloomberg.com/QT. Well, let's now discuss how companies are focused on driving growth as we head into 2023 with a potential recession looming, and why business leaders should think about trust when it comes to the equation. Ashley Reicheld is principal at Deloitte Consulting. She wrote a book on that. It's called The 4 Factors of Trust, How Organizations Can Earn Lifelong Loyalty. She joins us now. Ashley, great to have you with us this afternoon. When I think of brands and companies that have earned loyalty, companies that come to mind are Apple, Patagonia for many people, I think, Nike for a lot of people. And then there are those companies that have perhaps are in the process of losing loyalty right now. I wonder if a company like Southwest that's going through what it's going through, you know, canceling 2/3 of flights on a day like today and, you know, leaving passengers stranded for days at a time. What separates these two types of companies?
You know, airlines have had a particularly difficult year when you include the summer, when you include all of the vacation delays. It's been pretty tough. When you think about it, trust is at its core, do you make and keep good promises? And the challenge for airlines right now is they're making a lot of promises, but it's pretty hard to keep them given all the weather that's happening. The things that tend to distinguish our companies that do really well are they do just that. They make a good promise, which we describe as doing something with humanity and doing it transparently. Am I giving you all the information you need to make a choice?
Yeah.
And then can I deliver on that promise and can I do it reliably over and over and over again? Those are the 4 factors of trust that generate results for companies.
And when we talk about trust, are we talking about it just from the perspective of the company and its customers, or is this more about the company and its employees?
Whenever there's a human, an individual, you can have or lose trust. So really, if companies want to build trust, they can't just focus on customers. They have to first build trust with their employees.
Yeah.
And their employees, in turn, build trust with their customers, and that's what delivers those exceptional results.
What about in situations, Ashley, where maybe those two things conflict with each other, meaning the company's obligation to its employees and the company's obligation to its customers or other outside factors? One example that comes to mind this year that we saw, of course, was with Disney and Bob Chapek and the response to the Don't Say Gay bill, the idea that he had to sort of take a stand on something that, at least we know in hindsight, he didn't really want to take a stand on, but there were a lot of forces sort of pushing and pulling him in both directions that he had to address. How do leaders deal with those types of situations?
Well, you're talking about a new set of stakeholders these days than you had maybe 10 years ago. 10 years ago, it was pretty simple. Am I earning share returns from my holders? Am I returning value? I think these days you have many more people to balance, and that equation becomes much more multivariate and therefore much more challenging. You can't just make your shareholders happy. You have to do that because you've made your employees and your customers happy. And sometimes there is no perfect solution, but there are companies that even in times of great difficulty have done a phenomenal job. Since we were on airlines earlier, let me point to Delta as an example. When Delta started the pandemic, their sales overall, their carriage dropped 90%, I think. Mm-hmm. And yet the CEO at Bastion not only took a pay cut, but announced that they wouldn't furlough involuntarily a single employee. And they didn't throughout the entire pandemic. At the same time, they also made the choice to keep the middle seat open, leaving space between customers, which, maybe not scientifically backed, made everybody feel more comfortable. So it was a pretty difficult choice, and some argued at the time that could potentially lose needed revenue or drive up costs that they needed to shave. And at the end of the day, Delta came out on top. In fact, they're able to charge a premium for the service.
Hey, Ashley, we are someone, certainly Bloomberg, cover the public markets. We cover the private markets too as well. But when we're assessing the success of a publicly held company, we're looking at, the financials, we're looking at the balance sheets, we're looking at those metrics. When does trust become a metric that really values and is valued more by shareholders and investors? Because I do think a company that does good but doesn't do so well in terms of the top and bottom line, they're going to get punished.
That is very well said. And the truth is there's a very strong relationship between trust and performance. So, for example, in our research, trusted companies not only did better on average, they did better magnitudes of order more. In fact, up to 400%. Outperforming their peers. So we know that trust drives outsized value, and arguably it'll be a fiduciary responsibility. My hope is as we fast forward and we start to look into the future, trust and trust ID will be one of the measures that not only companies use to evaluate their relationships with their customers and their employees, but that shareholders can use to evaluate which stocks make sense, which companies are in position to drive real growth.
Ashley, are there any industries where this doesn't really matter? Like I think of industries with not a lot of competition, for example, like wireline broadband internet, for example, and cable providers that don't necessarily have competition, and routinely they're ranked when it comes to customer service among the worst when it comes to industries.
And what a fantastic example that is, because cable companies 10 years ago, man, you could wait around all day hoping that technician would show up, and maybe they would, and maybe they wouldn't, and maybe you'd have internet or not. But it didn't really matter because you could either have cable or you couldn't. There was no competition. But now if you fast forward 10 years and you have streaming service competition, you have internet competition, the level of service that you're getting from your cable company is dramatically improved. In fact, the same cable company that I had 10 years ago now pays you if their technician is late, which is a pretty dramatic change in terms of how people behave. So certainly if you're the only option, then all bets are off. But I think the good news about open markets is that doesn't stay the case forever.
All right, we're going to leave it on that note. Ashley, thank you so much. Really appreciate it. Ashley Reicheld, principal at Deloitte Consulting. Her new book, it's called The 4 Factors of Trust, How Organizations Can Earn Lifelong Loyalty. We appreciate her time on this Tuesday. Right now, it is time to check in on world and national news. First Word News. For that, we turn things over to Mark Crumpton. Hey, Mark.
Carol, thank you. China is reopening its borders to the world by removing its final COVID-0 restrictions. Starting January 8th, Beijing will no longer require inbound travelers to quarantine. They'll only have to obtain a negative COVID test within 48 hours. Meantime, the Chinese government may also reduce the frequency of reporting cases, ultimately changing to a monthly report. The U.S. Supreme Court ordered pandemic-era border restrictions to remain in effect. The move grants a request by Republican state officials who said lifting the rules would have produced an unmanageable surge of incoming migrants. Voting 5-4, the justices blocked a decision that was designed to invalidate the so-called Title 42 rule. The High Court order keeps the border policy in place while litigation goes forward. President Biden and Senate Majority Leader Chuck Schumer are transforming the federal courts at a blistering pace. Of the 97 judges confirmed by the Senate in the last 2 years, 3/4 of them are women, and nearly half of them are women of color, including Supreme Court Justice Ketanji Brown Jackson. Just 5 of the president's appellate and district court judges are white men. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
All right, Mark Crumpton, thank you so much. Mark Crumpton there. Coming up, folks, we're going to talk a little bit about the retail sector, how they did this holiday season. I don't know about you, Romaine and Tim, but this is now when the shopping begins with everything on sale.
I think so.
That's why I don't give my Christmas presents until, New Year's.
We're checking in with Dana Telsey. That's next.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
All right, well, Christmas has come and gone. A lot of people looking at the holiday shopping season and seeing how it stacked up against where we were in the last couple of years, and more importantly, where we are in relation to some of the predictions that folks had heading into this season. No better person to have this conversation with than Dana Telsey. Joining us right now in studio, she's the founder and CEO of the Telsey Advisory Group, a brokerage firm serving customers worldwide. I have a lot of questions here, Dana. So let's start overall. I'll give you the easy one. I mean, I think the National Retail Federation said something like 6 to 8% growth in holiday shopping. That was their projection. Are we going to hit that? Are we going to exceed that? What?
Well, look, we already heard MasterCard's number this morning from November 1st through December 24th, up 7.1%, a little bit lower than their 7.6% forecast, but compared to the 8.5% last year, which was a great year last year, it's still up. Was it really flattish if you include inflation? Probably, but the consumer's much more stressed this year than they were last year, not having the same amount of dollars from stimulus, and you have the high end on the luxury side impacted by housing and a volatile stock market. And even we're seeing the luxury growth rate moderate from what it was. It's a decent season, retailers have product to move, and consumers are going to get a bargain this week.
Well, we're already seeing it from Target. They're marking down things, I think, like 50% or so. I mean, so how do you net it, like, at this point? Because it sounds like there's a lot of caveats in what you just said.
And the reason why, we may have a good increase. What it means to the margins, to the bottom line, is different than a percentage increase. And I think we're going to see retailers have leaner inventories, but could the margins be negatively impacted? Yes. And I think next year, and as we go to 2023, just a couple days away, I think the focus is on expecting the unexpected, and it requires agility. So I think we're going to have a tough first half of the year. I think we'll have a better second half of the year. And these retailers, who can be the cleanest on inventory is going to be who wins the day.
So what's the unexpected to expect in the first part of the year?
I think the positive surprise would be a consumer that's stronger than expected, where you have, look at the jobless rate and you have people going to work again. The labor costs are running higher, so they're going to invest in discretionary goods, not just experiences. The negative part of it is you look at the retailers who are still going to have over inventory, and are we going to have margin pressure in the first half of the year? It's up in the air right now.
I am curious about the agility, where that comes from, specifically on the inventory level, because one of the reasons why they're in this situation is that the inventory supply chain, I don't care how well you're running your company right now, it is still broken. Yes. And so I'm just wondering, how do they do that? How do, at least the good companies, how do they find that agility?
Well, one of the things that we're seeing is when you think about the ordering patterns for the first half of 23, on average, many of the wholesale accounts are ordering down 10 to 15%. The reason why? To get some pricing power back. And when you think about this consumer overall, if we have a stock market that's even a little bit steady, that'll help us. Balance sheets are pretty strong. One of the interesting things, I was at one of the real estate conferences earlier in the month. Retailers overall are net store openers, not closers. The headwind is the fact that they may not have the HVAC equipment or the fixtures ordering in time to get the goods there. But we have healthier consumers. Yes, the savings rate's down, but retailers also have healthier balance sheets.
Two questions. Discounting. Did you see it earlier or hit the same as typically? I know, we talked about it.
Oh, you're talking to her. I saw it, definitely. Sorry.
Romaine, meet our guest, Dana Townsend.
Nice to see you.
But I mean, in terms of discounting, like, did it start a lot earlier or what?
Of course it started earlier. You look at the month of October with Amazon having its second Prime Day. You mentioned Target, Walmart, Old Navy, all having goods to move. And there's more goods to keep coming and moving. I think that the discounting is there. I think it impacts the margins, but I think it moves the inventory.
You know, one of the things I saw in Saks, like on Black Friday, was like you spend a certain amount of money and you get like $75 gift certificate. It was crazy. I didn't buy anything. Okay. Sorry.
All right. But in all seriousness, though, I mean, I saw a lot of those discounts prior to Christmas. And now, just 2 days removed from Christmas, I'm getting a ton of stuff in my email box now. And it's from certain retailers that aren't traditionally known for providing big discounts. I won't name them, but I was kind of surprised by that because I felt like there was a certain discipline that these retailers had sort of gotten over the last couple of years where they felt like they didn't need to discount, or at least not as heavily, in order to get you in the door.
I think part of it is everyone wants to be clean on the inventory to make way for new goods. Products don't increase in price the longer they sit on the shelf or the longer they sit on the website. So moving them out, moving out early, your first markdown is your most productive markdown. So I'm seeing what you're seeing, 50, 60, 70 off. Some of it from who you'd expect, some of it from who you wouldn't. But when they report their earnings, if they want to have a stock price that even holds steady, you better be lower on the inventory than last year.
Dana, back to the strength of the consumer, especially at this time as we head into 2023. Any indication that the strength that we saw over the holiday season is perhaps this last hurrah from the shopper?
One of the things we saw is a focus on events. Look at restaurants, which are continuing to have double-digit increases.